operating income not in P&L. Non-allowable expenses and from there now I want us to look at a question. So I read the question, then I'll show you how it is solved or computed. This is what the question says. Kamara, Susan and Kubasu are a partnership, trading as Kasuku traders, sharing profits or losses equally. They have provided the following statement of profit or loss for the year ending that 1st December 2021. We have the gross profit, VAT refund, foreign exchange gain, dividend income net, a profit or disposal of furniture, rent income, then total income, then less expenses, insurance premiums, legal fee, depreciation, repair and maintenance, VAT paid, sundry expenses, interest on capital for Kamara, Susan and Kubasu, motor vehicle expenses, custom duty, accountancy fee, bad and doubtful debts, rates and rent, salaries and wages, net loss. Additional information. Number 1. Insurance premiums include 282,500 paid to insure Susan's private car. Legal fee include parking fine, settling a dispute with a customer, appeal against tax assessment, court expense for breach of contract, preparation of tender documents. Number 3. Sundry expenses include interest charged on hire purchase, cash embezzled by cashier, registration of trademark. Number 4. Repair and maintenance comprised of the following: repair of furniture, installation of surveillance camera, cost of office furniture. Number 5. The partners took goods for personal use which had cost price of 225,000. The gross profit margin was 20% as recorded in the partnership books of account. The investment allowance were agreed with the Revenue Authority at 1475,000 during the year ending that 1st December 2021. Salaries and wages included salaries to the partners as follows: Kamara, Susan, Kubasu. So we are required to have the adjusted partnership profit or loss for that year and distribution schedule of the profit or loss computed in C1 above. So we prepare the income distribution schedule after getting the taxable income. So the first question is to get the taxable income of the partnership. Question is, which method are we supposed to use? Here we said if you are given net accounting profit, then you use the net profit method. Here we are given the net loss, which is a negative profit. That automatically means that you're supposed to use the net profit method. So we solve the question. We start with the name of the business, Kasuku Traders. Which is a partnership. We get the taxable income for the year ended that 1st December 2021. As we had said, when you are given the net accounting profit or loss or income, we start with it and then we adjust it. So we'll start with net loss provided, which we are given in shillings, and we have 2956,000 negative or a loss. Then we add, we had said when you're using the net profit method, you add non-allowable expenses in P&L and taxable operating income not in P&L. Non-allowable expenses in P&L and taxable operating income not in P&L. What does that mean? We usually start with the first item, non-allowable expense in P&L. Meaning, in P&L is the profit and loss account, which is the income statement. That in this income statement, as you can see, incomes were added and expenses deducted to get the net profit, which is a negative profit anyway. So we are saying, of those expenses that were deducted, is there an expense that is not allowable? So that now it had been deducted to get the net profit. It's not allowable. It's not supposed to be deducted. We add it back before we go to the last one. The last one I'll show you where we find it, because that one, as you can see, not in P&L. So we finish with this first one as we had illustrated earlier on. Let us start with the expenses. We just follow the ones that are in the P&L. Insurance premium. Insurance is for the business and it is usually allowable expenses. The other one is legal fee. Legal fee is also allowable as long as they have not extended to what they entail. Depreciation, no. Depreciation is not allowable, as we have been saying, so we add it. It had been deducted, remember, and it is not allowable. 75,000. The other one is repair and maintenance. Repair and maintenance, that is allowable. It's for the business and it's allowable. VAT paid, we said any form of tax we don't allow. Any form of tax, VAT is a tax, value added tax is not allowable. Had been deducted to get the net profit and it's not supposed to be deducted, it's not allowable. We add it back. Next, sundry expenses. That those sundry expenses are small expenses put together for the business and they are allowable. Interest on capital. We had even said it here that anything paid to the partners is not allowable. Partner salary, commission, interest, drawings, in private expense we don't allow. So that one had been deducted and it's not allowable. So interests on capital, which we have Kamara, we have Susan, Kubasu. So Kamara for 7,500. The other one is 185,000. The other one is 146,000. Then we continue motor vehicle expenses. Motor vehicle expense, those are expenses to run the motor vehicle. Don't say it's the cost of motor vehicle. When you hear motor vehicle, they are the expense to run motor vehicle, like fuel, repair. Those are allowable. But if they say the motor vehicle costs, that's now the cost of a motor vehicle. Fixed asset we don't allow. So this is allowable. Next is custom duty. Custom duty is a form of tax. We don't allow taxes. So we'll add it. Which we have 227,500. Next one is accountancy fee. Those are professional fee you pay. They are allowable because they are for the business. Bad and doubtful debt. Now when you hear doubtful debt, is a provision, a general provision, because you are doubting that they might not pay, they might pay. So it's just a provision. We don't allow provision unless it's specific provision for bad debt. The next one is rates and rent. Rates and rent, those are allowable expense because they are for the business. Salaries and wages, we also said those are allowable. They are for the business. They are revenue and commercial expenses. Now look, we are done with non-allowable expenses in P&L. Now we can look for taxable operating income, not in P&L. What does that mean? It means that an income that is taxable, but it has not been included in the P&L, in the income statement up here. So meaning it didn't increase the net profit that we have down there, although it's a loss, it's a negative profit. It didn't. So if it is not in the P&L, it didn't increase this net profit. Where do we find it? We can only find it in the additional information. So we go to the additional information to check for an income not in P&L. If they happen to be taxable operating, then we are going to add. However, when we go to the additional information, there's something else we normally check. You see, we say we are done with the expenses in the P&L, but you may go to the additional information and you are given analysis of that, those expenses that are in the P&L. Like the last expense we had salaries and wages in the P&L. You may go in the additional information and you're told that was to the partner. Remember, salary to the partner we don't allow. So we still come back and disallow it. So in the additional information, we not only look for taxable operating income not in P&L, but we also look for analysis of the expense in P&L. If they happen to be non-allowable, we still add them. Like if you go to the additional information number 1, we are told insurance premium incurred. Now insurance premium is an expense. When you go to the income statement, you'll find it is the first expense. So now we are told that one, it includes 282,500 paid to insure Susan private car. Those we don't allow. Why? Because they are private expenses of Susan, who is a partner. We don't allow. So we disallow the 282,500. Insurance, Susan car, 282,500. Then number 2, legal fee include. Legal fee is an expense. Now, is it in the P&L? Yes. When you go to the P&L, the second expense, legal fee. Now, we need to determine if there's a component that is not allowable of that legal fee, so that we add it because it is in the P&L. It included parking fine. Parking fine, we don't allow them. Let me analyze them, then I post the one that are not allowable. Parking fine are non-allowable, so that will add setting a dispute with the customer, that is allowable. So if you remember what we said, legal expense related to customer is allowable expense. Then the other one is appeal against tax assessment. We said any expense relating to tax is not allowable. Relating any expense, any form of tax we don't allow. Expense relating to tax we don't allow. So this is not allowable. It's relating to tax. Court expenses for breach of contract. We said that. Legal expense relating to breach of contract we don't allow. The other one is preparation of tender document. Now that is allowable expense. So now let us disallow the ones that we have said. Parking fine, $150,000. Tax assessment, expense, which we have 62,500. We have breach of contract, costs or expense, 400,000. Preparation of tender that we said is allowed. After that, we go to number 3. Sundry expense include. Now, sundry expense is in the P&L. When you go to the P&L, you will find it there. So we need to determine the part that is not allowable. It included interest charged on hire purchase. We had said interest on money borrowed is allowable. Interest on money borrowed. So hire purchase is like you had taken an item through hire purchase, you had borrowed it, so you are paying the interest. That's allowable. Cash embezzled by cashier. We had said any expense that is not income generating, we don't allow. So it doesn't matter who embezzled. As long as it's an embezzlement, it is not income generating. We disallow. We will add it here. The other one is registration of trademark. We had said expenses relating to trademark, patent, copyright, we don't allow them. So these two, we disallow. Cash embezzled, by cashier, 565,000. The other one is registration of trademark, which we have 281,250. After that, we go to the point number 4. Repair and maintenance comprised of the following. So, repair and maintenance, if you go to the P&L, you will find it. It is there, one of the expense. So, we check the part that is not allowable. We are told it included repair of furniture. Repair of furniture, those are normal business expense and it's allowable. Don't say it's relating to a fixed asset because it was incurred after the fixed asset had been purchased. It's already allowable. Installation of surveillance camera, that is the one that is not allowable because we had said when we were looking at the capital allowance, expense incurred before you start using a fixed asset. We normally claim capital allowance on them when we are claiming the capital allowance of that particular asset. So this one is not allowable because it's part of the cost of the fixed asset, the CCTV. Cost of office furniture, those are also not allowable because they are fixed asset. So we disallow the two. Installation of surveillance camera, where we have an amount of 812,500. The other one is the cost of office furniture. Costs of office furniture. Cost of office furniture, 525,000. Then we now go to number 5. The partners took goods for personal use which had a cost price of 225,000. The gross profit margin was 20% as recorded in the partnership books of account. So partners took goods, they were charged profit. It's like the goods were sold to them. Now they were at the rate of 20%. Now if you go to the income statement to check whether that profit is there, it is in the gross profit that you can see in the income statement. And what did we say about the income in the income statement? At the moment, we are interested with the income not in the P&L, not in the income statement. So if an income is in the income statement, we ignore for now. So we move on to the next one. Investment allowance were agreed with the Revenue Authority at 1475,000 during the year. Remember, investment allowance is equivalent to capital allowance. Capital allowance or investment allowance are allowable. Right now, we want the non-allowable expense in P&L. So that being allowable, we ignore. Number 7, salaries and wages include. If you go to the P&L, you'll find salaries and wages there. In that salaries and wages, we are told it included the one that were paid to the partner. We said anything paid to the partner, we usually don't allow it. So, salaries to the partner. Where we have Kamara, Susan, Kubasu, which we have 600,000. We have 450, and we have 225. And that is the end of the additional information, meaning we don't have any other item we are supposed to add because we are done with the expenses in P&L. Unfortunately, we didn't find taxable operating income not in P&L. Otherwise, it could have been in additional information. Now that we are done with the addition, remember we said now you come to the deduction. Deduction, we deduct 3 items. Less, non-taxable operating income in P&L, that is one. The second one is all investment income or investment incomes in P&L and allowable expenses not in P&L. So we are saying we first look for non-taxable operating incomes in P&L and all investment incomes in P&L before we look at the allowable not, because this one is not in P&L. We start with the first two. Now we go to the P&L and look for them, but I like to delete this part here so that I can continue, and then once we are done, I can come and we distribute here. So the continuation is here. So let us go to the P&L, look for non-taxable income Meaning that in this income statement up here, there could be an income that is not taxable that was included. We remove because it increased the net profit there. We remove because it's not taxable. 2, if there is any investment income here, investment income increased the net profit, we remove it so that we remain with operating income only, as we had said. So we start with the first income, gross profit. Gross profit is a taxable income and does not have an issue because we are in the business of buying and selling the goods. So the profit we make is a taxable. But there was additional information number 5, that the partners took goods for personal use which had cost price of 225. The gross profit margin was 20% as recorded in the partnership books. We said any income to the partner is not from the partner is not taxable. So it's like the partners purchase the goods from the partnership because they are being charged the profit. We remove that profit. So profit on goods taken by partner. By partners. So here we are told the goods, the cost of the goods was 225,000. This is the cost. I want to remind you that whenever you are given margin and markup, I know you have done financial accounting or financial reporting. You are told whenever you are given the markup or margin and you want to get the profit, you must be very careful. That, remember, I want to illustrate here. Remember, markup, let me start with the margin. Margin is usually equivalent to profit over sales, which in this case we are told is 20%. So 20% stand for 20 over 100. Now, we use the margin the way it is to get the profit if you are given the sale. Now, in our question, we are given the cost. The cost, we use the markup. Markup, which is the profit over cost. So, in this case, then we have to ask yourselves, how much was the markup? You don't have to worry. You just need to use the margin to get the markup. How? See here we have profit over sales. Margin is profit over sales, which is 20 over 100. Profit, it is 20 then. Sales is 100 then. And here in the markup we have the profit. So bring this 20 here because it is the same. It's a common factor in the markup and margin. Profit, 20. And then now get the cost. Remember, even when we are doing the gross profit method, we were saying a sale minus the cost of sales, we get the profit. Now, if you want to get the cost, remember here we want to get the cost. If you want to get the cost of sales, then take this cost of sales together with the negative to the other side, and the profit will bring here. Remember, profit is positive here. When it come here, it will be negative. Cost is a negative here. When it go beyond the is equal sign, it become positive. So it's like saying the cost will be the sale minus the profit. So in this question, do we have the sale? Yes, the sales is here, which is 100. So we take 100 to get the cost minus the profit. Do we have the profit? Yes, the profit is 20. The one that we have even used here, minus 20, meaning it is 20 over 80. So now that we have the markup, and the markup is the one that you use the cost, now we can apply it directly. This is fraction 20 over 80 times 225 because that is the cost. So we'll come here and talk of times 100 over 80. And not 100 over 80, 20 over 80. 20 over 80. We do the computation so that we can get the profit that was charged on the partners. 225,000 times this 225, let me confirm, is 225. 225 times 20 divided by 80, which give us 56 to 50. So 56 to 50 we minus. Remember, we are minusing because it's an untaxable operating income in P&L. So I now continue here. Now we go back to the P&L, look for other non-taxable income and investment. After the gross profit, we have VAT refund. VAT refund is not even an income because you just overpaid your VAT and it's being refunded to you. So we remove VAT refund. VAT refund 102,500. It is a non-taxable income. It's not supposed to be taxed. The other one is foreign exchange gain. We only said the non-taxable foreign exchange gain is the unrealized one. Unrealized we should not tax. Actually, if we were told unrealized, we should have removed because it had been included to increase the net profit and it's not taxable. But when it is cited, what does that mean? It means it is realized. So if we say that it is realized, so that is taxable, we won't remove. Dividend income net. Dividend is an investment income. And we said all investment income in P&L or investment income in P&L, we remove them. So we remove dividend income. And somebody may ask, do we remove the net or the gross? My answer is, you remove the figure that increased the net profit. The figure there, whether net or gross, right now they are saying net 562.5. The 562.500 is the one that increased the net profit that we are adjusting. So remove it, whether gross or net. The figure is the key, 562,500. Then profit on disposal of furniture. If you remember, we said income from selling fixed assets we don't tax. So had been included in the in the income statement, they increased the net profit, it is not taxable. So profit on furniture. So profit on furniture, which we have 591,000. The other one is rental income. We said all investment income in P&L we remove. Rent is an investment, we remove rent income, which we have for 15,000. And that is the last income in the P&L. So we are done with non-taxable operating income in P&L and all the investment income in P&L. Now we look at the last part, allowable expense not in P&L. An expense that was supposed to be deducted in the P&L in the income statement to get this net profit, it had not been deducted, meaning this net profit, it is overstated. So we need to remove it. If it is not in the P&L, where do you find it? You find it in the additional information. Let us go to the additional information for an expense allowable not in P&L. Now we start with number 1, insurance premium. Now remember, we want expense not in P&L. Insurance premium is in the P&L. Leave it. Number 2, legal fee. Legal fee, if you go to the P&L in the income statement, you'll find it there. Leave it. Including, don't say, like in the legal fee, we are told it includes settling a dispute with the customer and also preparation of tender. Remember, those we said are allowable. Don't go to the P&L and you won't find them and say now they have not to be deducted. No, all of them are in the heading of the legal fee. So they are all inside the legal fee that is in the P&L. So as long as the heading is in the P&L, ignore it. So number 3, sundry expense is in the P&L. Repair and maintenance is in the P&L. Number 5 was about gross profit, not even an expense. Number 6, investment allowance were agreed with the revenue authority to be 1475,000 during the year. Now, investment allowance or capital allowance, it is allowable. It had not been deducted because if you go to the P&L, you will not find it having been deducted there. So we deduct. It is allowable expenses, not in P&L. Investment allowance written as that, in short, or CA for capital allowance for the year. For the year. For the year. For the year, which is how much? Here we are told it was agreed to be 1475,000. 1475,000. We continue getting the allowable not in P&L. Number 7, salaries and wages include. Salaries and wages is in the P&L, and there is no other expense that is not in P&L. However, I want to mention this. Sometimes you may not be given this investment allowance agreed. Like you may not be given that point number 6. Let's say it is not there. If you are not given, make sure you come back to the expenses that you disallowed. Check if you have a fixed asset. Remember, fixed asset we disallow so that we come and allow the capital allowance, allowable expense not in the capital allowance. So if you are not given this, like in this case we had which fixed asset? Here we had installation of CCTV. If you remember, we said capital allowance is at the rate of 10%. And then the next one is the installation of CCTV. There was office furniture, cost of office furniture here. Remember, office furniture, we are supposed to claim at the rate of 10% as well. So if you are not given this capital allowance, we could have come here and say capital allowance on installation of CCTV camera, 10% of the figure that we have, 812,500, we minus that figure. Then capital allowance on furniture, 10% of 525,000, we get the amount before. But if you are given the capital allowance, then you are okay. So with that one, then we are supposed to now get, since there is no other, we have considered every factor here, we can get the net taxable operating income. So taxable operating income, I want to do that first. So what we do, we start with this negative, we add all these figures, we minus these figures so that we can get the net. So I'll start. The first one is 2956 negative. Remember to minus negative. 2956,000 plus now positive 575,000 plus 233,750 plus 407,500 plus 185,000 plus 146,000 plus 227,500 plus 155,000 plus 282,500 plus 150,000 plus 62,500 62 did it first plus 62,500 plus 400,000 plus 565,000 plus 281,250 plus 812,500 plus 525,000 plus 600,000 plus 450,000 plus 225,000. Then now we start minusing 56,250. We minus 102,500 minus 562,500. We minus 591,000 minus 415,000. We minus 1475,000. So giving us 125,250. So we have 125,250. Now, having gotten the taxable operating income, having gotten the taxable operating this one, I want you to get the difference with the sole proprietorship and also the company. For the partnership, we don't add investment income here. Investment income, first we have to distribute this operating income among the partner until here we get the total taxable operating income. So the total we get here will be the same as this. And then the investment income we add here. So the investment income are not added here. They are added in the distribution schedule. So for now, this we cross it that way for the partnership, because now we need to distribute. Now after that, we have answered required 1. We were supposed to get the adjusted partnership profit or loss for the year. Here it is. Required 2, distribution schedule for the profit or loss.
Hello and welcome to this session of Advanced Excel Formulas. In this session, we are going to cover formulas that are related to the if statements. If statements are advanced formulas that are normally used when you want to analyze your data and come up with formulas that will give you certain criteria. And with me here, I have created a workbook that will enable us to go through a variety of if statement formulas that are in use here. The first one that we are going to tackle will be the if statement formula. Now, if statement is a formula in Excel that helps in analyzing the contents of a single cell, and it analyzes the contents of a single cell and compares it against a condition that you've specified or a condition that you've stipulated. If the contents of the cell that you are analyzing surpasses the condition that you've set, then the formula will give you a true value, a true statement, or a true formula. But if the contents that you are analyzing don't meet or don't surpass the condition that you stipulated, then the formula will give you a false value or statement. So let us go straight to how the if statement is applied so that we can be able to see what happens if we use the if statement formula. So with me, I have come up with data that we are going to use. This is the student's grade sheet. It has column A through to column E. There is student name, there is the age of students, the exam score, there is age status, and there is grade. So we have a grade here. And first, we are going to look at the age status. And you can see the age status, we've stipulated a condition. There are conditions that have been stipulated here. Now for age, if the content or the cell that we are analyzing surpasses 20 as the condition, then the formula will give back youth. But if it is less than 20, the formula will give us teen. So if it is greater than, we can use greater than or equal to 20, the formula will return youth. But if it is less than 20, the formula will return teen. So let us see how that is to be done using the if statement formula. First, we are going to precede every formula with an equal sign. So every formula is preceded with an equal sign. Then we type if. Then double click on, you can see if checks whether a condition is met and returns one value if true and another value if false. So I'll double click on the if. Then you click on the value that you are testing, the logical test, the value that you are testing here, which is 34. So B4 where there is age, so 34. We are analyzing 34. We are analyzing 34. So if that cell, which is B4 and it represents 34, is greater than, so we are going to look at a condition that you've stipulated. If that is greater than or equal, now the condition is 20, we type 20. Now if B4 is greater than or equal to 20, comma, then the formula should give you youth. So the youth is going to be put in bracket in quotations. So full quotation, youth. Then you close the quotation. But if that is not met. If that is not met, then the formula should return teen. So the formula should return teen, and we are going to have the teen there. So if before the cell that you are analyzing is greater than or equal to 20, the formula will return youth. Otherwise, if that condition is not met, the formula will return teen. So teen is going to be there. You close the bracket, and after closing the bracket, you hit enter, and returns that this person is a youth. You can see the person is a youth because the age is 34. 34 is greater than 20, and therefore the formula returns youth. Once that has been done, you copy your formula down up to where Tonet Meg is, and the rest will be pre-filled. Now, Lewis is a youth. David Jack is a youth. Cheryl is a teen. Of course, the age is 18. Gary Hall is 15 years. That one is a teen. We have another youth here. Of course, everything has been brought by your formula or the formula that we entered. So if the age is greater than 20, the formula returns youth. But if the age is less than 20, the formula returns teen, as it has been seen in the if statement formula. Now again, we also have exam score, and we are going to analyze the exam score using the condition that have been stipulated here. Now, the condition is that if somebody scores greater than or equal to 60, the formula will return pass. But if somebody scores less than, this one should be less than. If somebody scores less than 60, the formula should return fail. So how is that particular formula applicable? So equal sign, then if, then you double click on the if. You click on the cell that you're analyzing, the cell that you're analyzing. In this case, you're analyzing 80. 80 is C4. C4. So instead of typing, instead of clicking, you can just write C4. That is if you know the cell that you're analyzing, comma. If C4 is greater than, if C4 is greater than or equal to 60, the condition is 60 here, 60, comma, then the formula will return pass. So pass should be in quotation. The formula should return pass. You close the quotation. Otherwise, the formula should return fail. So if the condition above on the left is not met, the formula should return fail. And fail should also be in quotation. So fail should also be in quotation like that. So after that, you hit enter, and the formula, of course, has some error. So we see where the error is. So if C4 is greater than or equal to 60, comma, the formula should return a pass. Otherwise, the formula should return fail. So let us see where the error in the formula is. And okay, so the formula is going to be redone. So if C4 is greater than or equal to 60, comma, then the formula should return pass. You close that, comma. If that is not the case, the formula should return fail. So the formula should return fail. Then we close the bracket and we punch enter. Let us see where the error is. C4 greater than or equal to, okay, so the comma was there after C4, then enter. Now it comes back. So we were putting the formula in just after C4, which was wrong. So if you miss a quotation, if you miss a comma, or if you miss where to place anything, the formula will give you errors, which is what we've encountered in our just concluded errors that happened there. So if you punch enter, then pass. That means if you score 80, the formula will return pass. Let us copy the formula down using the autofill here. So you click on the bottom right side of the formula, then drag it down all the way to Tonet Meg. So the rest, everybody who scored above 60, the formula returns pass. Anybody above 60, the formula returns pass. Anything below that fail, like Cheryl failed, got 50. Gary 40, that one failed, all the way to 72 here, that is Vim, who scored 72, and that is a pass. So that is how the if statement is applicable in analyzing whatever data that you have in terms of what we've seen here. So the formula can be applied in a variety of ways. You can use it to be able to determine whether your sales were high or they were low sales, or whichever any other analysis that you want to come up with. So that is the if statement. We now want to move to the second analysis, which is nested if. So on our other sheet, we have nested if, which we want to go to and analyze how different things can be done now using the nested if statement. Now, nested if statement, just like the if statement, it analyzes the contents of a single cell. It analyzes the contents of a single cell and compares it against a given condition, and compares it against given conditions. So it analyzes the contents of a single cell, but compares it against given conditions, compares it against given set of conditions, and it returns a true value or statement if the tested condition is met. Otherwise, it will be returning a false value or statement if the tested conditions are not met. So the nested if statement, it analyzes the contents of a single cell and compares the contents against several given conditions, so that it returns a single value statement or formula if one of the condition is met. Otherwise, if no condition is met, then it returns a single false value statement or formula. That is the nested statement here. So in this case, we want to analyze the grades of students on this student's grade sheet. And with me here, I have the students' names. There is Cat 1, there is Cat 2, there is Assignment 1, there is Assignment 2, there is presentation that was done, there is an exam that was also done, then there is total, then there is analysis for grade 1, and also analysis for grade 2 in that particular order. So first, we want to get the total. Remember, for you to get the total, it has to be the summation all the way from Cat 1 to exam. And the best formula that we can use here is AutoSum. You can see AutoSum. So you just click on sum and it predicts that indeed you want to sum everything on the left. So that is AutoSum. Then you punch enter. Or you can say sum. Then you double click on the sum. Then you just highlight what you want to sum up to exam. Then you close your bracket. Then you punch enter. That is the same thing. Anyway, I want to drag the formula down so that the rest of the answers can be pre-filled. Then I want to reduce this to 1 decimal place. 1 decimal place, which means I'll decrease the decimals here. You decrease the decimal so that it's 1 decimal place. Then there is grade 1, there is grade 2, and there is the conditions that we want to follow here. So you can either come up with A, B, C, D, E, or from distinction through fail. If a student scores above 75 or equals to 75, the formula should return grade A or distinction. If a student scores 60 or above, the formula should return either B or credit. If a student scores 40 or above, the student should return C or pass. If a student scores 30 or above, the formula should return D or refer. If a student scores 30, less than 30, if a student scores now less than 30, if a student scores less than 30, that one is to be changed, then that should be an E or fail. So we'll start A through E for grade 1, then distinction through fail for grade to here using the nested if statement. The only difference between nested if statement and the if statement is that for if statement there is only one condition, but for nested if statement you'll be comparing the contents of your cell against several given conditions. So straight to the formula, you precede your formula with an equal sign, then if, double click on the if. So if the cell that you are analyzing is where the totals are, if that is 23 here, H4, which is 23, is greater than or equal, the condition is 75, so greater than or equal to 75. If H4 is greater than or equal to 75, then comma, this formula should give you A. So you type A, then close it in the quotation marks, then comma. Again, if, again you double click on the if, the same H4, which is 23, is greater than or equal to, the other condition was 60, greater than or equal to 60, comma, then the formula should give you credit. So the next one there was credit. Then that one is also enclosed in the closing bracket, then comma. If the same cell, H4, formula is missing an opening here. So if, then we double click on the if H4, the same cell, is greater than or equal to 40, greater than or equal to 40, then the formula should give us C. So we're going to type C in quotation, so that will be C. Then you close the C like that. I missed here, so this ought to have been D. So I'm going to correct this to D. There is A, not B, but B, A, B, C. Then now we move. Again, if H4 is greater than or equal to 30, comma, the formula should return or give us a D. So that one is a D there. We close. But now we are on the last one. We have A, we have B, we have C, we have D. Now for the last one, there is no need of starting with if again. You just come up with the comma, then you bring the quotation. Of course, it assumes that whatever has been said already is not met. Then whatever follows will be E. That is what, if what is on the left is not met, then the formula should just give you E straight away. So if you don't meet to be in the category of A, B, C, or D, then you'd be in the category of E. Then you close the brackets depending on the number of brackets that are open. So how many brackets are open? 1, 2, 3, 4 brackets are open. You're going to close ours with, again, 4 brackets. So 1, 2, 3, 4. After that, you hit enter and it will give you that the first person indeed scored an E. So you can see our formula here, the way it has been typed on the formula bar, and that is what is expected of us to do. So you copy it down and the rest will just appear. A few people have gotten E's, others have gotten A, like 80 is an A, 43 is a C, 62 is a B, 39 is a D, all the way to 24 being an E, 85 is a A, we have C's, and we also have other D's there. So this is the score after analyzing these particular grades using the if statement formula. Again, we want to analyze the same thing, but now where there was an A or E or D or C, we are going to replace with distinction, credit, pass, refer, and fail in that order. This was 75. This was 75. Let me see if that was 75. It is correctly put. So again, we want to now replace with the distinction through to fail using the same formula. So equal sign, if, then you double click on the if the cell that you're analyzing is this 23 where there is total, that is E4, if that is greater than or equal to 75, comma, then the formula should give us distinction. The formula should give us distinction. The formula should give us distinction. Comma, if, again double click on the if, the same cell is greater than or equal to 60, comma, then the formula should give us credit. The formula should give us credit. So you enclose, comma, then again, if the same cell is greater than or equal to 40, then the formula should give us that was if it's greater than, that was pass, comma, then again, if the same cell is greater than or equal to 30, comma, the formula should give us refer. The formula should give us refer. You close the bracket, then the last one automatically, comma, then you bring in, the other one is fail. The other one is fail. Then you close with the number of brackets that are open. 1, 2, 3, 1, 2, 3, 4. That is 1, 2, 3, 4. So you're going to close with the 4 brackets. 1, 2, 3, 4. I hope all the brackets have been presented, and that one is a fail for that particular student. So this one had everything. There was 30, there was 40, yeah. So once that is pre-filled, you copy your formula down again, and let us see if it is corresponding to the way we needed. So you can see E is fail, A is distinction, C is pass, B is credit, C is pass, B is credit, D is refer, E is fail, A is distinction again. So this is how you analyze your data using if statement and also using nested if statement. So that is if statement and nested if statement.
Hi there, my name is Patrick Kamau Kamure, and I welcome you today to our lesson where we continue looking at the tax planning. You can see it's a continuation from our previous lesson where we started looking at the tax planning for the individuals and especially those in employment. And by the end of that lesson, after looking at various opportunities available to a person under the employment, we say that this lesson we are going to look at a question. So I'll read the question, then we see how we can solve the question. So here I read. Peter Samoei is an employee of Zawadi Limited and earns a salary of 140,000 per month, while his wife Sabina Wanga works in Lindi Limited, a firm in which Mr. Samoei controlled 18% of the share capital. Her salary is shilling 60,000 per month. Sabina Wanga owned the house which is occupied by the family, for which the market rental value is shillings 45,000 per month. The house was constructed in the year 2017 at a cost of 6 million, borrowed from Masako at an interest rate of 12% per annum. Sabina Wanga has insured the house and paid insurance premium of 4,800 per month and city county rates of 6,900 per annum. Mr. Samoei paid insurance premium for his family of 4,600 with an insurance company incorporated in Uganda but operating in Kenya. Zawadi Limited paid school fees of 8,000 for the couple's children, which was expensed in the firm's income statement. Required suggests 4 tax planning scheme that could minimize the tax liability of the family. So we are supposed to suggest 4 tax planning scheme that the family can use to legally reduce the tax they are supposed to pay, because that is what tax planning is about. So if you look at the question, let's go item by item. We spot an opportunity, then we indicate how it can be utilized. Peter Samoei is an employee of Zawadi Limited, earning a salary of 140,000 per month. There is no opportunity there. While his wife, Sabina Wanga, works in Lindi Limited, a firm in which Samoei control 18% of the share capital. There we have an opportunity. We said if the wife work in a company where the husband control 12.5% or more of the shares, the wife income is added to the husband income to be taxed together. But when it is less than 12.5%, it will be taxed separately, and in which case both of them will claim personal relief, and also the wife income will be taxed at graduated scale rates. So we put that down. So we had reached up to the second sentence. Now we continue. Her salary, now the wife, is 60,000 per month. Sabina Wanga owns a house which is occupied by the family, for which the market rental value is 45,000 per month. The house was constructed in the year 2017 at the cost of 6 million borrowed from Masako at an interest rate of 12% per annum. Sabina Wanga has insured the house and paid insurance of 4,800 per month and county rates of 6,900 per annum. So there is another opportunity from that point of the wife owning a house which she constructed through a SACCO loan. Now, in this case, remember, SACCO loan do not qualify for mortgage interest relief. Remember, we say that an opportunity available to an employed person is to use the mortgage interest relief to reduce the taxable income and eventually the tax to be paid. So what should she do, because it's not a mortgage? She should take a mortgage loan and use it to pay the SACCO loan. And now she will remain with the mortgage loan, in which case now she can claim the mortgage interest relief to be used to reduce the taxable income and eventually the tax payable. And we are going to show the amount, which we said is the lower of interest on the loan and the 25,000 per month or 300,000 per annum, whichever is lower. So what we are saying is that the wife, Sabina Wanga, should take a mortgage loan and use it to pay the SACCO loan so that she can qualify for mortgage interest relief to be used to reduce the taxable income and eventually the tax payable. With the lower of 12% per annum of the mortgage, that is now the interest, which is 720 for the whole year, and the limit, which is 25,000 per month times 12 for the whole year, 300,000. In which case we get the ROA to be 300,000. Now we continue. The second paragraph, Mr. Samoei paid insurance premium for his family of 4,600 with an insurance company incorporated in Uganda but operating in Kenya. So there is another opportunity, family insurance cover, that is life insurance cover. So if it is outside Kenya, a company outside Kenya, one cannot qualify for the insurance relief. So he should shift it to a Kenyan company so that now he can be able to claim the insurance relief to be used to reduce the tax payable. With the ROA of 15% of the premium he is paying, and we compare with 5,000 per month or 60,000 per annum, whichever is ROA. So number 3. So that's what we are saying. Mr. Samoei should transfer the family insurance cover from a company incorporated in Uganda to a company incorporated in Kenya so that he can claim insurance, insurance relief to be used to reduce tax payable with the lower of the interest, 15% of the premium, of which case, since we are not told whether it's per month or per year, we assume it's per month, so that we multiply by 12 to get for the whole year, and we compare with the limit, which is 5,000 times 12, 60,000 per year. The rest is that one. So we look at the last part of the question. The last part, which we are told, Zawadi Limited paid school fees of shillings 80,000 for the couple's children, which was expense in the firm's income statement. Now, we had said that if the company expends the school fees in the income statement, it is a taxable benefit on the employee. And since now we are advising the employee how he can reduce the tax liability, is we advise him to request the company not to expense the school fees in the income statement, so that it will become a tax-exempt benefit on him. So number 4. So if you look at the required, we were supposed to suggest 4 schemes, and the 4 schemes we have provided. So that is how you are supposed to answer that question. That is one question. I'd like us to look at another question to see how we can answer it. This is what the question says. Albert Kimeri is an employee of Ruaka Limited. He has provided the following information relating to his income. Number 1, he earned basic salary of shillings 60,000 per month. He is paid house rent allowance of shillings 30,000 per month. His wife Ravena Kimeri is employed at a salary of 54,000 per month with Tops Limited, where Kimeri hold 20% of the shares. Now, number 4, they both live in a house which is owned by the wife. The house was constructed through borrowed funds at an interest rate of 15% per annum. The employer paid school fees for the children of Albert Kimeri. He was a member of a unregistered pension scheme where the employer made contribution towards the scheme on his behalf. The wife ran a farming business where she earned 400,000 from the sale of farm produce. He is contemplating securing a bank loan for his children education, or an education insurance policy that will equally cater for their children's education. We are required to suggest a tax planning that will minimize the tax liability of the family of Mr. and Mrs. Kimeri for the year of income and the subsequent years. So in this case, we go through the question one by one, analyzing for any available opportunity. We start with number 1. He earned a salary of 60,000 per month. There is no benefit or opportunity that can be utilized there. Number 2, he is paid house rent allowance of 30,000 per month. Again, there is no opportunity that can be utilized there. His wife, Ravena Kimeri, is also employed at a salary of 54,000 per month with Tops, where Kimeri holds 20% shares. Like we said in our previous question, reducing the shareholding to less than 12.5%, so that the wife is tax separated from the husband, so that both can enjoy 2% relief, and the wife income can be taxed at graduated scale rate. So solution. So what we are saying is that Albert Kimeri should reduce shareholding at Tops Limited, where the wife worked to less than 12.5% from 20%, so that they are tax separatory in order to enjoy 2% relief, and for the wife income to be taxed at graduated scale rates. So we were in point number 3. So we now go to point number 4. They both live in a house which is owned by the wife. The house was constructed through borrowed funds at an interest rate of 15% per annum. Now, we are not told that the borrowed funds is mortgage loan. So borrowed funds does not mean mortgage loan. So we should advise, like the other one, that the wife should take a mortgage loan and pay the borrowed funds so that she can claim the mortgage interest relief to be used to reduce the taxable income and eventually the tax to be paid. So number 2. Now, since we haven't been told how much the fund was, we just state, yeah? So, the wife, Ravena Kimeri, should take a mortgage loan and use it to pay the borrowed funds in order to qualify for mortgage interest relief, to be used to reduce taxable income with the lower of mortgage interests and also 25,000 per month or 300, whichever is lower, to be used. We continue. That was point number 4. We go to point number 5. The employer paid school fees for the children of Albert Kimeri. There is another opportunity there that Kimeri should request the company not to expense the school fees in the income statement so that it will become a tax-exempt benefit on him. So number 3. So Albert Kimeri should request the company not to expense the school fees in the income statement so that it will become a tax-exempt benefit on him so that he's not charged tax. So that was point number 5. We go to number 6. He was a member of unregistered pension scheme where the employer made contribution towards the scheme on his behalf. Now, there's another opportunity there. Employer contributing to an registered pension scheme, it will become a taxable benefit on him. So he should join a registered pension scheme so that when the employer contributes for him, it will become a tax-exempt benefit. So you put it down. So Albert should join a registered pension scheme so that when employer contribute for him, it will become a tax-exempt benefit. As at the stand now, it is a taxable because it's unregistered. We continue. Number 7, the wife runs a farming business where she earns 400,000 from the sale of farm produce. For that one, there is no benefit one can derive out of that. So that one we ignore. 8, he is contemplating securing a bank loan for his children education or education insurance policy that will equally cater for the children's education. So the best opportunity is to take an education insurance policy so that he can claim the insurance relief to be used to reduce the actual tax payable instead of a loan. And we say that with the lower of 15% of the premium or 5,000 per month or 60,000 per annum, whichever is lower. So we are saying that Albert should take an education insurance cover instead of a loan for the children education so that he can claim insurance relief to be used to reduce tax payable with the lower of the 15% of the premiums or 5,000 per month or 60,000 per annum, whichever is lower. So that one, or that's how you answer the question involving the tax planning for the individuals. So there are some questions that you are going to do given after this video, so you can use them and test yourself. For today, we are going to stop there until I see you in the next lesson where we look at the tax planning for the limited company. Thank you very much.
Hi Rana, welcome to another session of Manifested Online Classes. In this session, I want us to continue with the subtopic number 1 of topic 2, that is revenue recognition at the IFRS 15. Remember in our previous class, we looked on how revenue should be recognized under IFRS 15, and also the various steps to be followed by an entity in terms of recognizing revenue. And then we went further and looked on how IFRS 15 should be applied in various contracts with customers. We have looked on how IFRS 15 is applied in hire purchase contract, and also what we refer as a consignment sale. So in this particular session here, I want us to look on how revenue is recognized under what we refer as a construction contract, and we are going to see on what is the rules, the principles laid down under IFRS 15 regarding recognition of revenue under what we refer as a construction contract. First of all, when talk about a construction contract, is a contract which is entered into by an entity with a customer, whereby the entity is expected to undertake some construction work, which will take substantial period of time for it to be completed, e.g. 2 years, 3 years, 4 years. And once the construction work is completed, the entity will be paid something called a construction or will be paid something called the contract price. So meaning that a company, for example, can secure a construction contract which will take maybe 3 years, and the company will be paid a contract price of a certain amount of money, maybe 100 million. So a question here arises, when should the company recognize that 100 million as a revenue? So IFRS 15 now comes in here to provide some rules regarding how that particular revenue should be recognized. But even before you look on that, maybe we can define what is a construction contract, and then we see how the revenue should be recognized as far as these particular contracts are concerned. So we can say this is a contract where an entity is expected to undertake construction work which is expected, or which will take substantial period of time to be completed. So mean that if an entity or basically a company secure a construction contract, and that construction work will take substantial period of time. When we talk about substantial period of time, we are talking of a period beyond 1 financial year. That construction work will take a substantial period of time for it now to be completed. That is known as a construction a contract. Now, what you have said is that IFRS 15 set out some rules regarding how the revenue should be recognized under such a contract, of which, according to that standard, revenue here should be recognized based on the progress of work. Based on what? The progress of work, or basically revenue should be recognized based on the work which has already been completed. And because in this case we are saying that construction contract will take maybe 2 years, 3 years, what the entity which is undertaking that particular construction work should do, so that it can be able to determine the amount of revenue to be recognized in each financial year, is to estimate the percentage of completion. To estimate the percentage of of completion, of which in this case we are going to look on the various methods which may be used by an entity in terms of determining the percentage of of completion. But even before we look on those particular methods, we can say that here revenue will be recognized, or we can say revenue from construction contract will be recognized, or is recognized based on the progress toward completion, completion, i.e. revenue is recognized based on percentage of completion. Based on percentage of what? Of completion. So the revenue to be recognized in any financial year, in this case we are saying, will always be based on what? The percentage of what? Completion. The percentage of completion. Basically what that means is that if, for example, the company has secured a contract, a construction contract, and maybe at the end of the first year, the contract, for example, is 30% complete. Is 30% complete? We're going to look on how this percentage of completion is determined. We have various methods. Assuming at the end of the first year, the construction cost contract is 30% complete, and then the contract price, which the company is to be paid by the customer, is something like 500 million, then the amount to be recognized as revenue in the first year, here we are saying, should always be based on what? The percentage of completion. Take the percentage of completion, multiply that with what we refer as the contract price. So that will give us now 150. So that is now the revenue which is supposed to be what? To be recognized. That's why we are saying that according to IFRS 15, the revenue here should always be recognized based on the progress toward what? Completion, or in very simple terms, revenue will be recognized based on the percentage of what? Of completion. Now, how do we determine this particular percentage of completion, which then is used by the entity in terms of determining the revenue to be recognized in a certain what? Financial year. So let's look on methods of determining percentage of completion. Methods of determining percentage of completion. So we have a number of methods, around 5 methods. So the first method is known as the cost to cost method. Cost to cost method. So under this particular method here, the percentage of completion of a construction contract is computed, or basically is determined based on the cost which has been incurred to date in proportion to the total estimated contract cost. So mean that to determine now the percentage of completion, under this particular method here, what do? We take cost incurred to date, all over total estimated cost, all over total estimated what? Cost, and then we multiply that with 100. So that's how we determine the percentage of what? Of completion. And basically this is the common method. This is a common method which is used in terms of estimating the percentage of completion. So the other method number 2, we refer to it as the output method. So this particular method here, or under the output method, the percentage of completion is determined based on the output achieved so far. So if, for example, the company has secured maybe a construction contract, and that company is expected to construct maybe some residential houses, like 100 units, and maybe at the end of the year, the company has been able to construct like 10 units. So in that case, what we do here to determine the percentage of completion, take the units which have been completed 10, divide that with what? The total units which are expected to be completed times 100. Times what? Times 100. So mean that here, to determine the percentage of completion, what we do is that we take the output achieved to date, and then we divide that with the total expected output. Total expected output times what? Times 100. times 100. So that is the other method which is used in terms of estimating now the percentage of what? Completion. So the other method we refer to it as the survey of work performed. Survey of work performed. Survey of work performed. Now, when talk about the survey of work performed, survey of work performed method, what generally happen here is that an entity or the company which is undertaking the construction work will engage a third party. Will engage a third party or even an expert to be able now to visit the site whereby the construction work is being undertaken and be able to assess the percentage of what? Of completion. So therefore here, the percentage of completion is determined by a third party or an expert by assessing, going to the field and basically checking the work which has already been done, and maybe from his experience he can be able to advise the entity that work is complete up to which percentage, and the entity now will use that particular percentage in terms of determining the revenue to be what? To be recognized. So therefore here we can say a survey is conducted by a third party, or an expert to determine percentage of completion. To determine the percentage of what? Of completion. So here we don't have any computation which is done, but we are saying that the entity here will engage who? An expert or even a third party to do what? To go to the site and be able to use his experience and advise the entity the percentage of completion of that particular what? Work. Then from there, we have the other method which is called technical estimates. Technical what? Estimate. So when talk about the technical estimate method, so here the entity will use, for example, the engineer to do what? To estimate now the percentage of what? Of completion, or in other terms, to advise the entity on the percentage of what? Of completion. So therefore, we can say that this entails use of an engineer, entails use of what? Of an engineer, use of an engineer to do what? To estimate percentage of completion, of a construction contract. And once now the engineer is able to do that, he has estimated the percentage of completion. He will go ahead and do what? Advise the company on the same. Advise the company on the same. So then we have the last method which is used in terms of doing the same, estimating the percentage of completion, which is called the time-based method. The time-based method. So when talk about the time-based method, so here the revenue will be recognized, or in other terms, the percentage of completion will be estimated or will be determined based on passage of time. Meaning that if, for example, a company has secured a contract and the company expects that that contract or that construction contract will be completed in the next 3 years. So mean that once the first year is over, then the company can say that that contract is 30% complete, and therefore the revenue now to be recognized in the first year will be a third or maybe 30% of the contract price. So therefore here we can say that revenue here will be recognized. Revenue is recognized based on the passage of time, time, or in other terms, we can just say that the percentage of completion here is determined based on the passage of what? Based on the passage of time. So there was a question which was there in the past papers and which was requiring you to explain some of these particular methods which are used by the entity in terms of estimating now the percentage of completion of a construction contract. So I also give that as an assignment at this point. Assignment, this is a question for May 2019, which is question number 4B. So that question was requiring you just discuss two methods used in terms of determining the percentage of completion, of which, remember, you have said that these are like the two common what method, output and also what the cost to cost method, the cost to cost what method. Make sure you check on that particular question and you attempt it. You also what attempt it. Then from there, want us now we proceed and look on the accounting treatment of this particular construction contract. So the revenue which is recognized, the cost which is recognized in a certain financial year, and also how the profit is arrived at as far as the construction contract is recognized, is concerned, that is, and how an entity determines something called a contract asset and also a contract what? A contract liability. So let's look on the accounting treatment. Accounting treatment of a construction contract, construction contract. So once a company has secured a construction contract, at the end of each year, the company should determine the profit or the loss to be recognized as far as that particular construction contract is concerned. So an entity should do what? Determine the profit or what? The loss to be what? To be recognized. We are going to look on how this profit or loss to be recognized in a certain financial year is determined. And two, an entity should be able to determine something called the contract asset or liability to be recognized in the statement of financial position. Remember, this is a profit or loss. This one should be recognized in the income what? In the income statement. So let's start by looking on how we determine the profit or the loss to be recognized in a certain financial year. A profit or loss to be recognized. Profit or loss to be recognized. So how do we determine this? So number one, we take the revenue. We take the revenue to be recognized in that year, and the revenue to be recognized in a certain financial year as far as the construction contract is concerned. This one we have said is always based on the percentage of what? Completion. Percentage of completion. The first thing you need to do as far as the construction contract is concerned, you determine the percentage of completion, because we are saying according to IFRS 5, the revenue to be recognized in a certain financial year always is based on the percentage of what? Completion. So determine the percentage of completion, and basically I've said these are the two main methods. Actually, this is the common one. This is a common one whereby you take the cost incurred to date all over the total estimated cost. So take the percentage of completion, then multiply that with the contract price. Multiply that with the contract what? Price. So you'll get now the revenue to be recognized during that financial year, and then to this you lay something called the cost of sales. So how do we determine the cost of sales? The cost of sales equally, this one is equal to percentage of completion, a percentage of completion of a construction contract, and then we multiply that with now the total estimated cost. The total estimated cost, the total cost to be incurred for that contract to be what? To be completed. So what you get here, if a positive figure is a profit, if a negative figure is a loss, to be recognized. To be recognized during that year as far as this contract is what? Is concerned. So that's how the profit or the loss to be recognized in a certain financial year as far as the construction contract are what? Are concerned. So let's look on how we determine then the contract asset stroke liability. Number two, contract asset, stroke liability, and we are saying that this is recognized as an asset or liability in the statement of financial position, So in terms of how we determine this, one, we take the cost which has been incurred to date, the cost incurred to date, the cost incurred to date, and then to this we add or less the profit or the loss recognized during that year. So the profit is added, whereas now the loss is what? Is deducted. And basically this particular profit or loss recognized, this is now what you will have computed here. The profit or loss recognized during that year. And then to this you less the amount, what? Invoiced and received. Amount invoiced and what? And received. The amount which has been invoiced and what? And received. That one should be deducted. And once you do that, you can get a positive figure here or a negative figure. So if you get a positive figure, we refer to that as a contract asset. A contract asset is like what? Is like amount which the client has not yet paid. This is basically an asset, contract asset. Whereas now a contract liability, this whereby a company which is undertaking the construction work maybe has received some amount in advance. There is some prepayment by the client. So that is basically what? A liability. So this one we have said will be recognized as an asset or liability in the statement of financial position. So therefore, these are the two items which, if you come across a question maybe from this particular topic, the examiner may require you to compute. You may be required to compute the profit or loss to be recognized during a 30 year and the contract asset or the contract what? The contract liability. So we also have a question as far as that is concerned. The same question there for for May 2019, and that is part C. So that is what I want us to do as an illustration of this subtopic of construction contract. So we have May 2019. Question 4C. So we go through the question, you see what we are told, and we are told Mijego Construction Limited carries out work on 4 construction contract during the year which ended 30th April 2019. So we are given the details of the contract. So we have the first contract A01, B02, C03, D04. Those are 4 construction contract. The figures are in million of shillings. We are given the contract price, the costs to date, the total estimated cost or the estimated total cost. We have the payment on account. When we talk about the payment on account, this is now the amount invoiced and what? Received. The amount invoiced and also what? Received. Basically, this is a payment on account. Amount invoiced and what? Received. And then we have the revenue recognized in the previous period, the cost incurred in the previous period, the administrative cost for each construction contract, and then you're given the commencement date, the date when each construction contract commenced. And then we have some additional information. You're told the company does not recognize profit until a contract is at least 5% complete. 2, the company's policy is to calculate the percentage of completion on the cost basis, meaning that the company determine now the percentage of completion using which method? The cost to cost method. 3, we are told the company prepares separate trading account for each word contract. So what you're required to do in Roman 1 is we prepare the trading account for each contract, showing clearly the revenue to be recognized, for the year which ended 30th of April 2019. Number 2, the income statement extract for the year which ended 30th April 2019, and then an extract of a statement of financial position showing the combined totals for all the contract. So what is we are required as far as Roman 3 is concerned is now we determine the contract asset and liability, because this contract as a contract asset or liability, we have said we take it to the statement of financial position. So therefore we start with Roman 1, whereby we are required now to prepare now the trading account for each contract. Now even before we do that, because in that case we are required to prepare the trading account showing clearly the revenue to be recognized, we have said that in this particular construction contract, the revenue are recognized based on the percentage of completion. So therefore the first thing we need to do here, determine the percentage of completion. From there you'll do we proceed, determine the revenue to be recognized during the current year, and also the cost to be to be recognized. So therefore that is the first thing we need to do here, to determine the percentage of completion, percentage of completion for each contract. Which method is being used by the company here? As per note number, additional information number 2, we are told the company policy is to calculate percentage of completion on cost basis, meaning that this one is determined using this formula: the cost incurred to date, all over total estimated cost times times 100. So we need to determine the percentage of completion as far as the 4 contracts are concerned. I hope you can see we have 4 construction contracts. We need to determine this for each contract. So which are those contracts? We have the first contract A01, we have B02, we have C03, and then we have D04. So we need to determine the percentage of completion for each of this construction contract. Percentage of completion. We're using this formula here. So we take the cost incurred to date for each construction contract. The cost to date for the first one is 180. This one is 480. This one is 963.6. This one is 33.6. So that is the cost incurred to date, because that is a formula we are applying there. We divide that with the total estimated cost. Are we given that? Yes, we are given the estimated total cost. For this one is 720. Definitely we multiply that with 100. For this one is 768 times times 100. This one is 1069.2 times times 100. And finally we have this one, which is 840 times times 100. So we need to determine now the percentage of completion, for each contract here, for each contract. So the first one, we take 180 divided by 720. So this will give us 25%. 25%. The other one we have 480 divided by 768 times 100, which is 62.5%. What about the other one? 963.6 divided by 1069.2 times 100. And this contract is 90.12% complete. What about the last one? We have 33.6 divided by 840. 840 times times 100. So this will give us 4%. Percent. Equally, there is some information which are given as far as that question is concerned, and we are told in additional information number 1, that the company do not recognize profit until a contract is 5% complete. So if you check on this particular percentage of completion which you have computed here, you'll be able to see whatever you have gotten for the last contract is less than 5%. Less than 5 what? Percent. If that is the case, a contract is less than 5% complete, it means that no revenue will be recognized. No revenue to be what? To be recognized. To be recognized. No revenue will be recognized. But for the other contract here, revenue will be what? Will be recognized. So what we also need to do before we proceed and prepare now the income statement, let's determine the revenue to be recognized. The revenue to be recognized. To be recognized. Remember, I've showed you how we compute this revenue to be recognized. We say the revenue to be recognized here. Revenue to be recognized here is always based on what? On the percentage of completion. Percentage of completion times the times what? The contract price. So we take the percentage of completion times what? The contract price times the contract price. So that's what we need to do here. So for the first contract, we take 25% times the contract price. The contract price is 780. But if you take on the information which you are given in that question, or in that contract, this contract commenced back in 2017, and we are required to determine the revenue to be recognized in 2019, and that's why down there we are given the revenue which has been recognized in previous years. We are given the revenue, for example, recognized in 2017 and 2018. So therefore, up to this stage, the revenue now to be recognized should be 25% of this. But in this case, we have to exclude the amount now recognized in the previous what? Years. So the amount recognized in the revenue recognized in previous years here is 78. So that will give us now the amount to be what? The revenue to be recognized during the current year. The same case for the other contract. We take the percentage of completion, 62.5, times the contract price, which is 1200, equally minus the revenue recognized in previous period, 180. So we do the same here. 90.12% times the contract price, which is 1020, minus revenue recognized in previous periods, which is 504. And here we have said that no revenue will be recognized. That contract is less than 5% what? Complete. Less than 5% complete. So let's compute this. So we take 25% times 780 minus 78. So that will give us 117. So that is the revenue to be recognized during the current year. During the current year, you have to also remember that these figures are in million of shillings. Million of shillings. So what about the other construction contract? 62.5 percent times 1200 minus 180. So that will give us 570. 570. What about the other one? 90.12 times 1020 minus 504. So which will give us 415.2. So in that case, we have said no amount which will be recognized there. No amount which will be recognized as far as the last contract says what is concerned. Okay. Yes. So I think having that, we already have now the revenue to be recognized. So before we proceed equally and prepare now the trading account for each construction contract, we also need to determine the cost to be recognized during the current year. Cost to be recognized during the current year. Remember also from our format there, we have looked on how we determine the cost to be recognized. The cost to be recognized. We have said take the percentage of completion times the total estimated cost. The total estimated cost to be incurred in completing that contract. We do the same here. Take the percentage of completion times the total estimated cost. For the first contract here is 720, but equally here we are going to less the cost recognized in the previous periods. Cost recognized in previous period is 60 million. We do the same for the other construction contract. The percentage of completion times the total estimated cost, 768, minus the cost previously recognized, 72. Here we take the percentage of completion, 90.12, times what? Times the total estimated costs, which is 1069.2 minus the cost recognized in previous period, which is 480. Equally, no cost is to be recognized as far as the last contract is concerned. So let's compute this. So here we have 25% times 720 minus 60, which will give us 120. Then we have 62.5 times 768 minus 72, which will give us 408. And then finally here we have 0.9012 times 1069.2 minus 480, which will give us 483.6. So in our case now we have we have the revenue to be recognized and also the cost to be recognized. So having that, now we can proceed and prepare the trading account for each construction contract. Why are we preparing that trading account? Is for us now to determine the profit to be the profit or loss to be recognized. I've said to do that, we take the revenue to be recognized, we less now the cost. And actually we have been able to determine those two items there. So let's prepare now the trading account. And this particular trading account will be showing the profit or the revenue for each contract and also the profit to be recognized during the current year. So I think we can just ignore the last contract here because no revenue, no cost to be recognized during this year. So we just consider the three contract, A01, B02, C03, and also our figures here will be in million of shillings. So we start with the revenue to be recognized during that year. So we have computed that revenue here. So we have 117, we have 570, we have 415.2, and then to this we less cost. We can just refer to that as cost of sales. So here we have 120, here we have 408, and here we have 483.6. And then from there, what we get here is the profit, all loss to be to be recognized during that year, as far as each contract is concerned. So let's compute this. So for the first contract here we have -3, which is a loss. What about the other one? We have a profit of 570 minus 408, which is giving us 162, a profit. And the last one we have 415.2 minus 483.6. So this will give us a loss of 68.4. A loss of 68.4. So therefore that is first of all what is required as far as that part is concerned. You are required to determine that particular revenue and the cost, and automatically now we compute what? The profit or loss now to be what? To be recognized. And then from there, we require now to prepare the income statement extract. The income statement, this is now for the company which is Mijengo. Remember the trading account which I have prepared here, this is a trading account which has been prepared to determine the profit or loss for each contract, for each what? Contract. But in this case, the income statement will be prepared to determine the profit or loss of this company during this year. So income statement extract. This is not for individual construction contract, but now prepared to determine the performance of the company during the current year. During what? During the current year. So how do we determine this, or how do we prepare this? First of all, we start by recording the profit or the loss recognized as far as each construction contract is concerned. So remember, in our case here we have 3 construction contract, A01, B02, C0 what? 3. So from the first construction contract there was a loss. From the other one, B02, there was a profit of 162, and finally we have a loss of 68.4. So, and then we get now the net amount, which now will be an income to this company. So we have what? We have 162 minus 3 minus 68.4. So that will give us 90.6, which is now like the total income. And then now to this we less what? Expenses. We less what? Expenses. Now, which expenses do we less here? We are lessing expenses which are general, and basically the general expenses is now what you are given as the administrative expenses. So we are given the administrative expenses for the first contract, which is 1.5, the other one 15, the other one 2.5. So the total administrative cost, this will be 4 plus 15, which will be what? Which will be 19. So which will be 19. So, and then what we get is the profit for the year. The profit for the year for this company. So that is a profit now which our company made during that year. 90.6 minus 19, which will give us 71 point what? 0.6. Yes. So that is it. That what was required as far as the Roman 2 of that question was concerned. And these are obviously the items which were to give you now the 3 marks there. So finally, we are required to prepare an extract of a statement of financial position. And here I've said what the examiner was requiring is you determine something called the contract asset or the contract what? Liability. The contract asset or the contract what? Liability. So let's have that here. Roman 3, a statement of financial position extract, showing what? Contract asset stroke what? Stroke liability. Stroke liability, and we're going to do this as far as our 4 contracts are concerned. So we have the first contract, which is the A01, B02, C03, and then we also have D04. Yes, so how do we determine the contract asset or liability? So in this case, one, we have said we take the cost incurred to date, cost incurred to date, and we have the cost incurred to date from the information we have there. So here we have 180, we have 480, we have 963.6, and here we have 33.6. So to this, then we have said we add all minus the profit or the loss recognized during that year. So when we have that information here, for this, the first contract, there was a loss which was recognized of 3 million. A loss, we less it, but a profit we add. Then here we have a profit of this one, we add. Then here we have a loss of 68.4. That is a loss. So as far as the last contract is concerned, there was no profit or loss which was recognized. And finally, to this I've said we less amount invoiced and received. Amount invoiced and received. And we have said the amount invoiced and received is what is known in our question as payment on account. Payment on what? On account. The payment on account for the first contract here is 156. This one we less it. Then here we have 780. We less it. Then here we have what? We have 918. We less it. And here we have what? We have 24. We have 24. Yes. So what then we need to do is to determine now the contract asset stroke what? Stroke liability. So a positive figure is a contract asset, a negative figure is a contract what? Liability. So let's start with the first contract. We have 180 minus 3 minus 156. That will give us 21, which is a contract asset. And then we have 480 plus 162 minus 780, which will give us negative 138, which is a contract liability. And then the other contract we have 963.6 plus 68.4 minus 918, which will give us positive 114. And finally here what do we have? We have 33.6 minus 24 minus 24, which will give us what? 96, which will give us 96. And I think equally we can determine the net amount here. So we add all this, we determine whether from this 4 contract, whether we have a contract asset or a contract what? Liability, by adding all this. So you have 9.6 plus 114 plus 21 minus 138. Yes, so in that case we get a positive figure of 6.6 million, which automatically is a contract what? Asset, and that will be taken to the statement of financial position of this company as what? As an asset. As what? As an asset. So that is it, that what was required as far as that particular question is concerned, and equally that what you need to know as far as the construction contract are what? Are concerned. So therefore that brings us to the end of our lesson.
We move to question 4. Question 4. I rub this, assuming we have taken it down. Okay, so we move to question 4 of the paper. Question 4 is all computation. Part A is testing taxation of insurance companies. Part B is testing VAT. So let's start with Part A. Riziki Insurance Company Limited was incorporated in the year 2019. The company deals with different classes of insurance. The following trial balance was extracted from the books of account as of 31st December 2021. So we have a trial balance balancing at 23,420,000 shillings. So it is a trial balance, meaning it has balances of assets and liabilities, it has revenues, it has expenses and all that. So it is upon us therefore to differentiate separate the items that we need and only pick those that we shall use to answer the question. So we have a trial balance. Additional information 1 says, claims intimated and outstanding as of 31st December 2021 amounted to 750,000 for motor vehicle insurance and 480,000 shillings for fire insurance. So this is a question testing taxation of general insurance. Remember, the activities of an insurance company could be in the form of general insurance and life insurance. So the rule is, where an insurance company offers both general insurance and life insurance or life assurance, then the two are treated as separate businesses and they are taxed separately. So this is on general insurance. And general insurance again can have different classes. Like in this case, we have motor vehicle insurance and fire insurance. So let's analyze the additional information. 1 says, claims intimated and outstanding as of 31st December 2021 amounted to 750,000 for motor vehicle insurance and 480,000 shillings for fire insurance. Now, claims are almost the major expense of an insurance company. So just like in any other businesses, we can have claims outstanding at the beginning and at the end of the year. So here we have 3 figures that we shall have to adjust for each of these. We have claims outstanding, that is accrued claims brought down, that is at the beginning of the year. We have claims paid during the year and claims outstanding or accrued at the end of the year. So in short, we shall have to adjust the claims account so that we determine the figure to the income statement. 2, an earned premium is maintained at 80% and 50% of the net premiums received for motor vehicle and fire insurance respectively. An earned premium is maintained at 80% and 50% of the net premiums received for motor vehicles and fire insurance respectively. Now, what do we do? In tax, the government taxes taxpayers on income earned, not necessarily what is received. So what we shall do here is simple. We shall work out the net premiums received. Net premiums received is simply total premiums received less premiums returned. In insurance business, as a company, you can receive premiums from your insured, but then because of certain reasons you may have to return. So net premiums received is simply the difference between the two. So what we shall do is simple. Determine the net premiums received, then deduct the unearned premium so that we only tax that which has been earned. 3, investment allowances have been agreed with the commissioner at 1.2 million shillings for the year ended 31st December 2021. Investment allowances have been agreed with the commissioner at 1.2 million shillings for the year ended 31st December 2021. Now, this insurance company has non-current assets, like the first item in the trial balance is property, plant and equipment at 10.2 million shillings. We know this depreciates, but for tax purposes, depreciation is a disallowable expense. Instead of depreciation, we allow for what we call capital allowances or investment allowances, which are computed at a uniform rate for all businesses. 4, so we shall allow this as an expense instead of depreciation. 4, investment income analysis. So in the trial balance, we have an item they are calling investment income, a total of 4.15 million, sorry, 4,150,500. 4,150,500. So this is the analysis. 1, we have interest received from government securities, 2,040,000 shillings net. Net here means after withholding tax has been deducted. So interest received from government securities, 2,040,000 shillings net. Now, interest income is subjected to withholding tax at the rate of 15%. So net here means this figure is 85%. Now, the next thing is, how do we treat interest income received by a company? This is a company. Now, for companies, Withholding tax of 15% on interest income is not final tax. So what we shall do is simply to gross the amount given, that is get 100% of it, tax the 100%, but when computing the tax liability, we shall deduct the withholding tax of 15% already paid. Next we have interest received from local banks. Interest received from local banks, 760,500 shillings net. Net again means after withholding tax of 15% has been deducted. The treatment is the same. We shall gross the amount, tax the gross amount, deduct the withholding tax already paid when computing the tax liability. 3, we have dividend received from a Ugandan company. Dividends received from a Ugandan company. That reminds you to remember your treatment and classification of dividends. Now, this is dividend received from a Ugandan company, meaning it is a dividend income received from outside Kenya. The rule is that is an exempt dividend. So remember your classes of dividends. We have exempt dividends, qualifying and non-qualifying. So this being an exempt dividend of 450,000 shillings gross. Gross means without or rather before any taxes. We shall leave it out as an untaxable income. We have dividend received from a local company of 900,000 shillings net. 900,000 shillings net again means after withholding tax has been deducted. For dividend income, withholding tax rate is 5%. So that means this is 95% of the figure earned. So this is dividend received from a local company. Now the correct classification is this is a qualifying dividend. So what we shall do is simple. Qualifying dividends are dividends whose withholding tax is final tax. So we shall not tax it again. We shall not tax this again because it is already net of withholding tax. 5. Fees paid to investment managers amounted to 750,000 shillings for the year ended 31st December 2021. Fees paid to investment managers. This is an allowable expense, and so we shall show it as one of such. Required 1. Taxable income or loss for Riziki Insurance Company for the year ended 31st December 2021, and 2. Compute the tax payable, if any. So this is what we do. We say we are answering question 4A. So we show each class in a separate column. So we have motor vehicle insurance, motor vehicle insurance. We have fire insurance. Then we have total here. Then show the currency. Okay. So we start with the premiums. So if you look at the trial balance keenly, there are a number of items touching on premiums. So 1, we have gross premiums received from direct clients. So we can start with that. Gross premiums received from direct clients. So motor vehicle, we have 3 million. Fire is 2.5. The sum should be 5.5 million. Next we have gross premiums received from agents. So gross premiums from agents. Motor vehicle is 2 million. Fire is 1.2 million. That should be 3.2 million. You can get, if you go to the trial balance again, down we have what they are calling premiums returned. That is payments that were received from clients but paid back again. So we have motor vehicle is 800, we deduct, this is 700, a total of 1.5 million. Another thing touching on premiums is whether here up to here we can get net premiums received. Net premiums received. So net premiums received, total premiums received less what was returned. So for fire we have, this is motor vehicle, this is 5 minus 8 is 4.2. So we write here 4.2 million. This is 37 minus that is 3 million, a total of 7.2 million. Then we use information 2 to work out unearned premiums. So we say less unearned premiums. That is 80 and 50% respectively. 80% for motor vehicle and 50% for fire. So we begin, we get 80% of 4.2 million. That is 3360. 3360. So up to there we can get earned premiums. So that will be 3360 from 4200. I get 840,000. We move here. 50% of 3 million is 1.5 million. Less that is 1.5 million. So total earned premium for the year will be the sum of the two. 840 plus 1.5. That should be 2340. This is 15 plus 3360. 4860. Good. Next, we add other taxable income. So we say add other taxable incomes. Add other taxable incomes. We only pick those that are taxable. So we make use of the trial balance and the additional information. One, we have what they are calling commission. Sorry, before we go to other taxable income, there's something else touching on premiums. We have what they are calling reinsurance premiums paid. That is, insurance premiums paid by this company to a reinsurance company. So we should deduct that so that we have what we call net premiums. So we say reinsurance premiums paid. So for motor vehicle it is 400. For fire it is 150. That is 550. So we get the difference again. We get net premiums. This is 440. This is 1340. 1350. 1350 plus 440 should be 1790. 1790. Up to there, we now bring in other taxable income. So say add other taxable income. So we separate the other incomes and only use those that are taxable. One, we have what they are calling in note 4 investment income. Investment income. One, we have interest from government securities. So we write here interest from government securities. So the amount is net, so we gross it. So we shall do 100 over 85 of 2040. We do that together. 100 over 85 times 4, 2040. That gives me 2400, 2.4 million. We add it here. Next, we have interest from local banks. Interest from local banks. The same process, 100 over 85 times 760.5. We do it together. I get 894.71. Yes. Dividend from Ugandan company not taxable. Now in exams, if you don't make use of any item provided in the question, please explain why under your notes and assumptions. So you can say under notes and assumptions, 1, that dividends from a Ugandan company is an exempt dividend, hence not taxable on Riziki Insurance Company. Again, I repeat, dividends from a Ugandan company are exempt dividends, therefore not taxable on Riziki Insurance Company. 2, dividends received from a local company are qualifying dividends because withholding taxes have already been deducted. So you can say dividends received from a local company are qualifying dividends, hence not taxed beyond withholding tax. Dividends from local company are are qualifying dividends, hence not taxable beyond withholding tax. We go to other incomes, if they are there. We have what they are calling commission on reinsurance ceded. That is a taxable income. Commission on reinsurance ceded. So that reminds you to be able to understand what we call commission on reinsurance ceded and commission on reinsurance accepted. So commission on reinsurance ceded is a taxable income. Commission on reinsurance accepted is an allowable expense. We bring it here. We say commission on reinsurance ceded. For motor vehicle, we have 700. This is 300, a total of 1 million. Any other income? We do not have any other, so we can get total income. Total income. So remember, we are asked to get total taxable income of the company. So we are basically interested in this column here. So we have 1790 plus 2400 plus 894.71 plus 1 million. That should be 6,084.71. That becomes the total income of the business. Because we are using the gross profit approach, we move to the next step and say less allowable expenses. We only use those that are allowable. So we go to the additional information 1, which is about claims. So we run claims as working 1. So I want to run working 1, which is about claims. So I can do it here, then we shall wrap. So working 1, claims. So we run claims account. Claims account. So we start with motor vehicle. We are carrying 3 zeros. So if you look at the trial balance keenly, we have what they are calling claims outstanding as at 1st January 2021. That is accrued claims brought down. So motor vehicle, we have 1.1 million. So we write here, balance brought down 1.1 million. Then have balance carried down, information 1. Claims outstanding as of 31st December 2021 amounted to 750,000 for motor vehicles. So we write here 750. Then we debit the account with the claims paid. So we write here bank. So claims paid For motor vehicle is 2770. 2770. Balance of the account. We do it together. 2770 plus 750 is 3520. 3520. Income statement, that is allowable claims, will be that minus 1100, which I get to be 2420. So that will be the allowable claims for motor vehicles. We do it for fire, claims account fire, insurance. The same procedure with the same rules. Balance brought down, that is accrued claims at the beginning of the year. For fire is 840,000. Balance carried down, that is information 1 is 480. Claims paid, bank, fire is 2110. Balance of the account 2110 plus 480 is 2590. 2590. Income statement, that is allowable claims for fire insurance, index 840, 1750. And with that we have the allowable claims. So here we have 2420. Here we have 1750. Get the sum of the two. I get 4170. And with that we are done with the claims. We are done with this working, so we can grab it. We move to other allowable expenses. We have information 3, which is about investment allowance. So I said those are allowable instead of depreciation. So we write here investment allowances or capital allowances, given at 1.2 million total for the year, that is. Information 4 we have talked about, that is the analysis of investment income. Information 5 is about investment managers fees paid. So investment managers fee, a total of 750,000 for both. And up to there we are done with the additional information. We go back to the trial balance and identify any other allowable expenses. So be very keen. 1, we have commission on reinsurance accepted. Commission on reinsurance accepted. For motor vehicle is 600. Fire 200, a total of 800. Next we have sundry receivables, that is a balance, not an expense. Bank balance is a balance, an asset, not an item, not an expense. We have directors' fees. This is a company, so directors' fees are allowable expenses. Directors' fees is 495 in total. We bring it here. 495. Reinsurance premiums paid we have dealt with. Claims outstanding at the beginning of the year we have dealt with. Claims paid we have dealt with. Legal costs on claims are allowable expenses. Legal expenses on claims. Motor vehicle is 280. This is 130. 130 plus 280 should be 410. 410. Sundry expenses on motor vehicle claims are allowable expenses. Sundry expenses on motor vehicle claims, a total of 220. Nil for fire, so total is 220. Management expenses are allowable expenses. So management expenses Motor vehicle 450, 380. That should be 830. Investment income we have dealt with. Premiums returned we have dealt with. Profit and loss account is a balance, not an income, not an expense. So up to there, we can now get taxable income. So taxable income will simply be total income less total allowable expenses. So there are two ways of doing it. You can either deduct each of these from the total income, so that would mean we bracket each of them, or we can get total allowable expenses, have it here, then we deduct it from our total income. So let's use the first method. Good. So this is what we are interested in. So we get total taxable income. Be very keen. So taxable income is total income less allowable expenses. So we have 84.71 less, we are here, 4170, 1200, 750, 800, 495, 410, 220, and 830. 830. I have 279, 2790, 2790.29, but negative. So in short, this company realized a loss during the year 2021. So that is part A, Roman 1. Part A, Roman 2 is asking, compute the tax payable, if any. Tax payable, if any. Now, tax is imposed on income. And for a business firm, income is basically profit. So because this particular firm made a loss or realized a loss in this particular year, it is not liable to any tax. So we simply give an explanation for that. So we say part 2, you can write, Riziki Insurance Company Limited is not liable for taxation for the year 2021 because it realized a loss and not a profit. So the company is not liable for taxation in the year 2021 because it realized a loss and not a profit. Then you can go ahead and say tax is imposed on incomes or profit, that is for business purposes. Tax is imposed on income, in bracket profit, but not losses. Yes, so that explains why for this particular year, this company would not have to pay any corporation taxes. And that marks the end of part A of question 4. The topic being tested here is advanced taxation of business income, that is advanced aspects of taxation of business income. The topic is a must in the exam, and in each paper you'll meet at least 2 questions from that particular topic. So be very keen and make sure you understand every bit of it. With that, I want us to move to part B of question 4. Let me wrap this. Part B of question 4. Now, part B of question 4 is a mathematical question again, testing VAT. So that reminds you to have VAT at your fingertips. Know the theory around VAT, it's so much, and then know how to compute VAT and the applicable rules. So I read, be very keen. Zawadi Associates provides consultancy services to various clients whose terms of contract allow clients to pay for the services either before or after the provision of the service. The following information is provided regarding the firm's transactions for the months of October, November, and December in the year 2021. The following information is provided regarding the firm's transactions for the months of October, November, and December in the year 2021. So we have a table of 4 columns. The first column is the nature of the service or transaction. Second column is value of the transaction. The third column is service provision date, and then the last column is payment date. So we have a number of transactions and then all those details. Additional information 1. Siloc Investments was declared bankrupt on 30th November 2021. Now, Siloc Investment was one of the customers, one of the clients, and we are told it was declared bankrupt on 30th November 2021. Let's look at the table and understand what happened in that transaction. So, the transaction was management consultancy to Siloc Investment. The value of the service was 1,440,000. The service provision date was 13th November 2021. Payment date was 40% paid on 30th November 2021. 40% paid on 13th November, meaning 40% of the amount was paid on the service delivery date, and the rest was to be paid later. Then come to information 1. This client was declared bankrupt on 30th November. What does that mean? If a debtor is declared bankrupt, it means you cannot recover the debt from them. So it means you have to write it off. And that means you'll have to, it will reduce the amount of VAT you will collect from this debtor. So what we do is simple. We shall show this as a transaction, yes, but it will be a deduction under output tax. 2. On 5th November 2021, Zawadi Associates renewed its National Industrial Training License for 30,000 shillings and paid for legal fees of 360,000 shillings to follow up on clients who were not paying as per the agreed date. So it had 2 transactions. One was renewal of industrial training license fee at 30,000. Then 2, it incurred a legal fee of 360,000 to follow up on clients who were not complying with the terms of the contract. So we have to determine if these are vertible or non-vertible items. Now, renewal of industrial trading license fee is not, renewal of national industrial trading license is not a vertible item. So yes, this is an expense, but it will not attract VAT. Legal fees are professional services, and so they will attract VAT. 3. Electricity bill paid on 10th November 2021 was 270,000, out of which 100,000 shillings was payment for outstanding bill for October 2021, and 20,000 shillings was in respect of additional deposit as demanded by the power company. So let's get it keenly. Total amount paid was 270,000 on 10th November. 100,000 out of that was payment for October, and then 20,000 was a deposit for the following month. Now, what does that mean? It means, in short, not the entire 270,000 was relating to November. So what we shall do is simple. We are going to explain what we call tax point, and in this case, we shall have to split this 270,000 for 3 months. 100,000 for October, 20,000 for December or after November. Then the difference, that is 270,000 minus 100 minus 20, that should be 270 minus 120, which is 150, is the amount relating to November. Good. For fuel consumed for partners' vehicles amounted to 90,000 during the month of November 2021. Fuel is a vertible expense, and so we shall charge VAT on that. So we are told it was 90,000, and we are told it was for partners' vehicles. So this means it was for business purposes. Remember, one of the rules in VAT is you can only claim input tax on business expenses or business items, but not private or personal expenses. Computers purchased for business use cost 240,000 in November 2021. Again, this is for business and so it will attract VAT. Zawadi Associates paid rent for the month of November 2021 amounting to 180,000 on 5th November 2021. Zawadi Associates paid rent for the month of November 2021 amounting to 180,000 on 5th November 2021. Now, rent is not a vatable item, so we can show it, yes, under input tax, but the rate will be nil. It is an exempt item. 7. Transactions have been stated inclusive of VAT at the rate of 16% where applicable, unless otherwise stated. Now, when computing VAT, the figures given may be inclusive of VAT, to mean the figures already have the VAT amounts within them. So that means if the VAT rate is 16%, then the figures are at 116%. So in that case, be very keen, the VAT rate applicable will be 16 out of 116. So this is where the figures are given inclusive. But where the figures given are exclusive of VAT, it means they do not have the VAT amounts within them. So the figures are around 100%. So it means the VAT rate will be 16%. So this is exclusive. Be very keen on that. Many students confuse the two and they end up with wrong figures, and that makes them fail. Required. 1. Compute the VAT payable by or refundable to Zawadi Associates for the month of November 2021. November 2021. So remember, we have transactions affecting, or rather touching on October, November, and December. So the question is, compute the VAT payable or refundable to Zawadi Associates for the month of November 2021. Now, this means we have to understand something called tax point. Now, tax point in simple terms is simply the date or the time when VAT is deemed due and payable. The date or time when VAT is deemed due and payable. Now, for local supply, that is for transactions within the country, tax point is the earliest of 4 dates. The earliest to mean that which comes first. 1. The date the services are supplied or the products are supplied or sold. 2. The date when the date when an invoice is issued or received. 3. The date payment is made for part or full settlement of the transaction. And 4. The date a certificate is received. That is in case of transactions requiring supervision, like in constructions where an architect certificate has to be issued and all that. So what we do is simple. Look at each and every transaction, locate the tax point, and if the tax point is November, then we shall capture that transaction in November. If it is not in November, we shall leave it out, because the question is, we compute the VAT payable, refundable for the month of November. So let me use the first transaction, for example. The first transaction was audit services to XL Supermarkets. Audit services to XL Supermarkets. Value of service was 700,000. Service provision date 25th October 2021. Payment date was 5th November 2021. So you can see the service was provided on 25th October, but then the payment was on 5th November. So what does that mean? This transaction should be captured for VAT purposes in the month of October, but not November. So what we do is simple. Analyze each transaction, then locate the tax point. If it is within November, capture it under November. We answer that. So this is question 4B. So we say Zawadi Associates value added tax computation for the month of November. For the month of November 2021. So we start with output tax. Output tax is the VAT on sales. Output tax We arrange it like this. We have date, we have details, we have gross amount in shillings, VAT rate, then VAT amount in shillings. So remember, we have to determine the tax point. So transaction 1 was audit services to XL supermarkets. The service provision date 25th October. Payment date is 5th November. So that was captured in October. We don't bring it under November. Next, we have training services to Kyle Securities, provided on 3rd November and not yet paid for. So that means the tax point is November. So we write here 2021 November. So the date was November 3rd. The customer was Kyle Securities. The value of the transaction was 240,000. And we are told this is inclusive of VAT. So that means the VAT rate is that 16 out of 116. So we do 16 out of 116 times 240,000. I get 33,103. Sorry, 33,000. Sorry, 16 out of 116 times 240,000. 33,103.45. Next, accountancy services to Watoto Children's Home on 5th December 2021, the service provision date. Payment date was 20th November. So November comes before December. So tax point is November 20th. Watoto Children's Home. Watoto Children's Home. Now Watoto Children's Home is, the value is 600,000. This is a service provision to an NPO, a non-profit making organization. So for such, it is nil. That is nil. Debt collection services to Zoella Computers. Service provision date 9th November. Payment date 30th November. So again, this is a November transaction. We take November 9th. That is Zoella Computers. Zoella Computers. Paid 20,000. 16 out of 116. 16 out of 116. 20,000. I get 113, 103.45 again. Next we have strategic plan development to Bazo, that is Rwanda Limited. So the company is in Rwanda. So what does that mean? This was an exported service. For exports, we know VAT rate is nil, 0%. So we write here, the service provision date was 10th November, not yet paid for. So it means it is a November transaction. So we say Bazo, in bracket Rwanda Limited. The amount is 2,150,000. The rate is 0%, meaning the amount is 0. We have management consultancy to Siloc Investment. Service provision date 13th November. 40% paid on 30th November. The rest not yet paid, meaning it is a November transaction. The tax point is in November, that is. So we write here Siloc Investments. 14 40,000. 16 out of 116. 16 out of 116 times 40,000. I get 198 620.69. 620.69. Lastly, we have financial consultancy to W. Before that we have internal controls reviewed of Lema Limited, value 960,000, service provision date 18th November, but then payment date was 7th October. So it means the payment came before the service provision date. So that means the tax point is in October. So we don't capture that in November. Lastly, we have financial consultancy to W Limited. Service provision date 20th November, payment date 1st December. So we pick 20th November. So we say W Limited, 1.2 million. 16 out of 116. 16 out of 116 plus 1.2 million. 165,000 517.24. Then we have information 1, that is Siloc investment being declared bankrupt on 30th November. So that will reduce the VAT from that in client. So let's understand it. When the service was provided on 13th November, 40% of the amount was paid. That is 40% of 40,000. Then the rest was not yet paid. And this is on 30th November. So we are not losing the entire amount. What we are losing is simply the VAT on 60% of 1.44 million. So that is what we need. So 60% of 144 million, I get to be 864,000. We should deduct times 16 out of 116. I get 119, 172.24. We deduct because it was a loss, a bankrupt issue. All the rest are transactions affecting input tax. So up to here we get what we call total input tax. Total input tax, total output tax. That is total VAT on sales. We be very keen. 113, 103.45, 198, 620.69, 165, 517.24, less 119, 172.24. I get 391, 172.59. That gives me total output tax. That is step 1. Step 2 is to get our input tax. That is the VAT on purchases and expenses. The same arrangement. So, but we are getting input tax. So we are going to follow the same procedure. But now we are looking at expenses and purchases. Again, we must be keen on which expenses and purchases attract VAT, which ones do not. So I move to information 2, which is about renewal of National Industrial Training License at 30,000 and then legal fees of 60,000 paid on 5th November. So I come here, write 5th November. 1, we have National Trade Industrial Training industrial training license at 30,000. That does not attract VAT, so the VAT rate is nil. Still on the same date, there was legal fees incurred or paid of 360,000. Legal services are professional services attracting VAT, so 16 out of 116 times 360,000 should be 49,655.17. Information 3 is electricity paid on 10th November. So we write here electricity, but we have to break down the figure. Total amount paid was 270,000. 100,000 out of that was for October, then 20,000 was a prepayment for December, meaning the amount relating to November is only 150,000. So write that. Electricity is a variable expense, so we charge. So 16 out of 116 times 150,000. I'm getting 20,689.66. 4, we have fuel for the partners' vehicles at 90,000 paid in November. So we can write here 10 fuel. That is at 90,000. Fuel is a petroleum product. Petroleum products attract VAT currently at 8%. So if this is inclusive of VAT, it means it will be 8 out of 108. So we shall have 8 out of 108 times 90,000. That is 6,666.67. Then we have computers purchased in November at 240,000 for business purposes. So computers 240,000 for business purposes. I am getting 33,103.45. Note 6. Zawadi Associates paid rent for the month of November amounting to 180,000 on 5th November. So rent is not a variable expense. The amount was 180,000. The rate is nil. The amount is nil. Transactions have been stated inclusive of VAT. So up to here we get total input tax. Total input tax. The sum of all that, 49,655.17 plus 2689.66 plus 666.67 plus 33,103.45. I get 114.95. That is total input tax. The next step now is to compute VAT payable or refundable. Now in this case, this trader had both taxable supplies and non-taxable supplies. So what we do therefore is to restrict the deductible input tax. So we say VAT payable or refundable is equals to output tax less deductible input tax. Deductible input tax is equals to taxable supplies divided by total supplies times input tax. Taxable supplies are simply those supplies attracting VAT, that is, sales at standard rate and sales at zero rate. Total supplies will be taxable supplies plus now the exempt sales, or those sales attracting VAT at nil rate. So we go back to our output tax table. So if you are keen, we have supplies attracting VAT at standard rate, those at nil rate, and those at zero rate. So to get the numerator here, this figure here, we add all the transactions attracting VAT at nil rate, at zero rate and at standard rate. So look at the table keenly. We pick everything, that is the gross amount for every transaction, except those attracting VAT at nil rate. So if you are keen, if you are there, we have the list. There is one transaction attracting VAT at nil rate, that is the supply to Watoto Children's Home, which I said is an NPO. So it means we get the sum of everything except that 600,000. So do it with me. We have 240,000 plus 820,000 plus 2150,000 plus 1440,000 plus 1.2 million, then minus 864,000, that is the budget written off. So I get 4986,000. We say this is equals to 4986,000. To get the numerator, simply add exempt transactions to that figure. And in our case, you only have one of 600,000. To that figure, we add 600,000. I get 86,000 times input tax. Input tax is here, 114.95. So we get it together. So we have 4986,000 divided by 5586,000 times 114.95. I get 98,287.35. Therefore, we say VAT payable. It is VAT payable where the total output tax, our total output tax we got to be 391,152, is more than the deductible input tax, which is 98,287. Where it is the other way around, it becomes VAT payable. So it's VAT refundable. So we say therefore VAT payable will be equal to 391,152 .12 minus 98,287.35. We do that. So 391,152.12 minus 98,287.35. I get 292,864.77, and that becomes the VAT payable for this particular month of November 2021 by this firm. And that marks the end of question B, part 1. We move to part B, Roman 2 of the question. It says, Zawadi Associates is planning to engage a firm of financial management consultants from South Africa to facilitate online training on financial management assignments. Zawadi Associates is planning to engage a firm of financial management consultants from South Africa to facilitate online training on financial management assignments. Advise Zawadi Associates on the tax point in respect of such services. Advise Zawadi Associates on the tax point in respect of such services. This is again touching on what we have been talking about. Now, in this case, This company is planning to engage a firm of consultants from South Africa. So what does that mean? It means, in short, it will be importing this particular service from South Africa. Now, the rule is that for imported products, that is for imported goods and services, tax point is the earliest of 3 dates. Earliest of 3 days. Number one is the date when the service is provided. 2, the date when payment is made in full or part settlement for the contract. And 3 is the date when the invoice is issued. So in short, you can say tax point for imported services is the earliest of the following 3 dates. Tax point for imported services or products is the earliest of the following 3 days. 1, the date when the services are rendered or provided. 2, the date when an invoice is received. And 3, the date when payment is made in full or part settlement for the contract. So in short, for Zawadi Associates, the tax one, that is the date when they have to account for that particular transaction under VAT, will be earliest of those 3 particular days. And that earns you the 3 marks awarded there. And that marks the end of question 4. Yes. Again, that reminds you that VAT is a very common exam area. Be very familiar with it, know the theory part of it, and the computation part of it. The rules as well around VAT computation. A very important part is to know the classification of supplies. We know not all supplies are VATable, so we should know which supplies are VATable at standard rate, which ones are VATable at 0 rate, and which ones are VATable at, which ones are exempt supplies. Yes, and that is it.
Welcome to Manifested Publishers. We pick it on question 2. We read the question. We say that with an aid of a well-labeled diagram, explain the concept of production possibility frontier. That is PPF. We put it on the board. We say with that's 2A, with the aid of well-labeled diagram, explain the concept, explain the concept of production possibility frontier. Production possibility frontier. With the aid of a well-labeled diagram, explain the concept of production possibility frontier. That is PPF. That is PPF. With the aid of a well-labeled diagram, explain the concept of production possibility frontier. The first thing that we need to understand is that what is a PPF? A PPF, we need to understand, is the locus or point joining together different combination of 2 goods that can be produce an economy when resources are fully and efficiently utilized. So we have the diagram. On this other end, we can call it consumer goods. We can have down here producer goods. So we have our PPF. So there's a point along the PPF curve. We can call it P. We have Q. We have R. We have S. And then finally we have T at this. Then we have points that are inside the PPF curve. And then we have points that are basically outside the PPF curve. So very important is to understand that this is the PPF curve. This is the PPF curve. And to the core, we need to understand what basically happens at each and every point of the PPF curve. The first point is the point on the PPF curve. So we say that P, Q, R, S, and T, we say represents, those ones basically represents attainable with the country, with the country level of resources, with the country's level of resources, with the country levels of resources and technology, assuming that the resources have been basically have been fully employed. That is attainable. So we can look at a point that is point N, that is into bracket outside. We call it outside the PPF curve point. That is outside the PPF curve, a point that is outside the PPF curve, a point that is N outside, cannot be attained. That one cannot be attained with the given, we say with the given level of resources, and technology. So that point that is outside the PPF curve, that is N, is unattainable. Then we have point M, that is inside. We call it inside the PPF curve. That is a point that is basically inside the PPF curve. So represent, this is basically represent, we say represents unemployment, represents unemployment. That point basically inside represent unemployment or inefficient or inefficient use of resources, or inefficient use of resources. Just to emphasize what we have done, we say that number one, that the PPF curve is a locus of point joining together two different combinations of goods that can be produced by a firm when resources are fully and efficiently utilized. So we have the points that are on PPF curve. Those points are attainable with the country levels of resources and technology, assuming that resources are being fully employed and no wastage. We need to and no wastage. Assuming that resources have been fully employed and there's no wastage. The second one is the M. That is the point that is outside the PPF curve. We said cannot be attained with a given level of resource and technology. Then we know that the point that is inside the PPF curve, that basically represents unemployment or efficient use of the resources, inefficient use of resources. Some of the areas that as learners need to maybe be emphasized on is uses of the PPF curve. You know, as you look at that question, one of the things that also needs to come into your mind is what are the uses of PPF curve? What are the uses of where do we apply the PPF curve? That is a good area that learners need to actually emphasize on, and that is how we tackle that question. That is question 2, Roman A. Question 2, Roman B. Argue 3 cases in favor of foreign direct investment, that is FDI, in list developed countries. We put it down, we say B, that is still B, argue 3 cases in favor of foreign direct investment, into bracket FDI, in least developed countries. On that particular question, one of the first things that needs to be understood is what is the FDI? That is a direct investment by a host country in the productive asset of a foreign country. So in this case, for example, you have countries investing in productive assets in the least developing countries. So what are arguments in favor? When you talk about arguments in favor, you are basically talking about advantages of the FDI in the least developing countries. One of the first advantage that we know that fill the gap in resources, fill the resource gap in least developed countries. Number one, fill the resource gap in the least developed countries. Fill the resource gap in the least developed countries. The second advantage or in favor of FDI, we basically talk about promote creation of employment, promote creation of employment, in the least developed countries. Number three, we can talk about promote investment, promote investment in the least developed countries. We say number four, we can talk about promote transfer, promote transfer of technology, transfer of the technology through skill transfer, through the skills transfer. So promote what you call technology through the transfer of the skills. But apart from that very question that we've talked about, we can also look at, as learners, you can also look at areas, for example, factors that will promote FDIs in the developing countries. Again, an examiner could also ask on the next maybe exam that are to come in the future, arguments against now the disadvantages of FDI. So those are some of the areas that needs also to be assessed by learners, needs also to be looked at by the learners. That is how we tackle that question. That is question 2, Roman B. We pick it on the next question, that is question 2, Roman C. C, Roman 1, explain the term consumer equilibrium. So say we write the question, that is C, Roman 1, explain the term consumer equilibrium. Explain the term consumer equilibrium. When you talk about consumer equilibrium, we basically say that consumer equilibrium is a point where the budget line is basically tangent to the indifference curve. So consumer equilibrium is the point where the budget line is tangent to the indifference curve, where the budget line is basically tangent to the indifference curve. We say that consumer equilibrium is a point where the budget line is basically tangent to the indifference curve. Key things that we are able to establish when we are defining, or when we draw, or when we look at consumer equilibrium, because we have two commodities, that is on the y-axis could have good y, on the x-axis we could have good x. So at that very point we are able to establish equilibrium quantity of good y, and at the same time we are also able to establish the equilibrium quantity of the good x. That is how we go about that question. We pick it again on question 2, Roman C, that is C Roman 2. Using a well-labeled diagram, using a well-labeled diagram of indifference curve, illustrate the consumer equilibrium position. Illustrate the consumer equilibrium position. So we draw that consumer equilibrium position. So we have it on this other end. Consumer equilibrium position, we can have the budget line. First of all, the budget line, we call this A, and we call that B. We call that A, and we call that B. We have indifference curve 1, so that is IC1. We have indifference curve 2, that is IC2. We have indifference curve 3, that is IC3. We have indifference curve 4, that is the IC4. So where is the consumer equilibrium? It is basically established at indifference curve 2. Basically established at indifference curve 2. So this is good y on this end. I have good x on this. So I have xe on this, then I have basically ye at that very point. So we have established equilibrium position. So we know that IC1 to IC3, IC1 to IC3, IC1 to IC4, IC1 to IC4 is the indifference curve. Then you have here is E, indifference curve. We have that as the indifference curve. We know that point E is what you call consumer equilibrium. We call it consumer equilibrium point. That is E is what you call consumer equilibrium point. And then we are also able to have YE, equilibrium quantity of Y. Then XE, that is equilibrium quantity. We call it quantity of X. Equilibrium quantity of X. We know that that is equilibrium quantity of X. Equilibrium quantity of X, that is for XE. Something that we also need to establish, we need to understand that AB is basically the budget line. AB is basically what you call the budget line. So the explanation, we need to understand we need to understand that a consumer will always want to be at higher indifference curve. If you look at that, consumer will definitely would want to be a consumer. Consumer will always want to be at higher indifference, what you call the higher indifference curve, because we know that because there is higher what you call higher satisfaction. And the point that we know that E the consumer equilibrium position, and we find it at IC2. E at IC2, consumer equilibrium position, where the budgeter line is tangent to indifference curve 2, where the budget line is basically tangent to the indifference curve 2. So when you look at that, this particular question, one of the things that we are able to establish, is that the first part is the diagram. Though the diagram indicate what each level means, so together we've drawn the diagram, we've indicated, and we've also shown the equilibrium position that the examiner requires, and we've also explained that point and what happens to the indifference curve and why a consumer would want to be at a high indifference curve. We know that the higher the indifference curve, the higher the level of satisfaction. That is how we approach that very question. We pick it on question 2, that is Roman D. Summarize 4 types of unemployment in least developed countries. So that is D. Summarize 4 types of unemployment in least developed countries. So the first thing that we need to understand is to understand the question, what is unemployment? And the second thing is least developed countries. So whenever we talk about unemployment, is a scenario where we have people who have the qualification to work and are willing to work, but there is not employment. Least developed countries, these are countries that are not yet there in terms of at higher level of development. That is what we call least development countries. So what are these type of unemployment that are there in least developed countries? One of it we can talk about open unemployment or naked. Open stroke naked unemployment. So whenever we talk about naked unemployment, we're basically saying that people are willing to work, but there's no work to do. People are willing to work, but basically there's no work to do. And that's we experience in least developed country. That is to say, this is a condition in which people have no work to do. This is a conditions in which people have no work to do. They are willing and able to work, but there is no work. There is no work to do. There is no work basically to do. So we proceed to what we call the second one, what we call structural unemployment. We said that on the structural unemployment, these are what call due to structural changes. What are these structural changes? Change in demand, change in taste, and change in fashion would cause unemployment. So we have it what we call structural unemployment. Structural unemployment. We say this is due to the structural. This is due to the structural changes. Structural changes in the economy. Structural changes in the economy. Structural changes in the economy. We say, for example, changes in fashion, tastes, and demand. These are some of the factors that we find that in a least developed country would cause unemployment. That is a structural unemployment. We proceed to the next. The next we can call it, we can have what we call unproductive. Number 3, unproductive. We call it the unproductive unemployment. We call it the unproductive unemployment as one of the unemployment that occurs in least developing countries. So when you talk about unproductive, workers do not have necessary tools of work. As a type of employment, it occurs as a result of workers not having necessary tools to work. Occurs when workers do not have what you call necessary tools of work. Necessary tools of work. When workers do not have necessary tools of work. We can have the 4. We can call it seasonal. Unemployment. Seasonal unemployment. So whenever we talk about seasonal unemployment, we are basically looking at temporary. When you talk about type of employment, we know that results from temporary. The word is temporary. Results from temporary work. For example, where do we get them? Construction. Where do we get them? I.e., when you talk about seasonal is common changes in season, not temporary, but that should be change in the season. Change in the season, not temporary. Temporary should be casual. This we call it due to changes in the seasons. For example, we say tourism, where we have a peak and off-peak seasons, where we have peak season and then we have off-peak season. So where we know that, for example, the periods, when you talk about, for example, periods that are peak season, where we know that there's a lot of employment. Peak season and off season. Peak season, there is employment, especially the December. Peak season, there is employment, and off-peak season, off-peak seasons, there is unemployment. There is unemployment that in tourism sector. That is what we call seasonal unemployment, that we basically experience what we call off-peak season. We can have the last one. We just discussed the last one. Casual unemployment as one of unemployment. casual unemployment as one of the type of unemployment that we basically experience, in the least developed countries. These are temporary. We call it temporary employment. Employment. For example, i.e., in the construction, we call it in the construction sector. So when you talk about constructions of road, this, remember, basically a casual employment where you have them for a particular time, they're very temporal. And after that time, the individuals that are basically engaged in such works will definitely lose their work, lose the work. And as we conclude on that, key areas that learners need to assess. You need to look at why is unemployment a major policy issue in the least developing countries. What causes unemployment? What causes unemployment? What is the relationship between unemployment and relationship? That is the Phillips curve. That is also a very good area that learners or those that are particularly preparing for exam need to look at. And that is how we assess that very question.
Dear learner, welcome to our continuing lessons in human resource management on the platform of Manifested Publishers e-platform. Today we are going to look at the subtopic of human resource administration. So the subject is human resource management, and the topic that we are going to look at today in human resource management is human resource administration. And this topic of human resource administration has several subtopics. We are going to get an opportunity to look at employee contracts, which are very crucial in human resource management. We are also going to look at human resource records management. We will also look at human resource management information systems, employee welfare services. Then we'll also look at health, safety, policies and procedures. Then we will also look at basics of payroll management. And ultimately, we will be able to have a look at employee discipline. So our subtopic today is employee contracts. Employee contracts. So Lana, welcome to the lesson. So what we need to appreciate as students and those interested in human resource management is that employee contracts, like in any other engagement, are very critical and central in terms of the agreement between the employer and employee. And when it comes to employee contracts, these ones are agreements that may be entered into orally or in written between an employer and an employee in relation to terms of service. So employee contracts refer to agreements that are entered into between an employer and an employee regarding a service of employment. Employee contracts may be oral or in writing. So dear learner, it is important to appreciate that employee contracts refer to agreements that are entered into between an employer and an employee regarding service of employment, and employee contracts may be oral or maybe in writing. Now, the burden of ensuring that the employee contract is in writing, according to the law, is placed on the employer. So as a human resource practitioner, you will be expected to ensure that regardless of where you are as an employee or an employer or representing an employer, employee contracts are entered into. So what are some of the basic information in contracts of employment? Basic information in contracts of employment. Basic information in contracts of employment. So it is important, learner, that a contract of employment captures some basic information, and this basic information is what can be used to enforce a contract of employment in cases of a dispute between an employer and an employee. So the first thing that should be there, names of employer and employee. Names of the employer and employee. This is very important so that this identifies that this contract is between employee A and organization B. That is very important, that must be captured. Then there is the element of the job title. So if, for example, the employee is being employed as an office administrator or as a company secretary, then that one should be indicated that this is the name of the employee, and the job title for which this employee is being employed is, for example, company secretary, is, for example, human resource manager, for that matter. Then duties and responsibilities. You may have location of work. Then you also have duties and responsibilities. Duties and responsibilities of that given employee. Then you may have terms and conditions of employment. Then you may also have number 6, the date when the contract is signed. The date when the contract is signed. 7, the commencement date. Date of the contract. You may also have an indication of the law that may prevail or be used in case of a dispute. Like, for example, if this is in the Kenyan situation, then the Employment Act 2007 may be used. Then 9, the working hours. Of the employee. Then you have number 10, the privileges and benefits. Then you have 11, leave entitlements. Then you have number 12, termination requirements. For example, notice, pay in lieu of notice. And then number 13, union representation. representation. Now, dear learner, when it comes to the basic information, this will vary from position to position, but these are some of the aspects that need to be covered. And when you talk about the name of the employer and the employee, we have discussed that. The title, we have said, for example, the employee could be a company secretary, or human resource manager. So that has to be indicated. Then the location of work, maybe this particular person, the work, maybe the person is based in Nakuru or Nairobi. So that has to be indicated. Then duties and responsibilities that this particular individual may be doing. Then here, there will be specifics. Specifics, for example, if it's the company secretary in charge of the company secretarial duties in that particular organization, if it is a human resource manager, then it could be, for example, recruitment, training, reward management. Then when it comes to terms and conditions, now the terms and conditions will indicate, for example, is this particular individual entitled to, let's say, a car, or maybe a house, or reimbursement, or to authorize certain things and so on. Then the date when the contract is signed, that is very critical. Commencement date of the contract, the law that may be used, and we have said here, for example, in Kenya, for example, Employment Act 2007 could be the law, the main law that may be used if this particular, for example, contract is in the Kenyan situation. Then you have the working hours. Maybe this employee is supposed to have maybe a 40-week work, or maybe the employee is supposed to have 8 hours per day for 5 days. And this could, for example, be indicated that this is from Monday to Friday. So then that becomes very clear that these are the working hours of this particular employee and so on. Then you have privileges and benefits. For example, if this employee has to travel, maybe air travel, you may say the employee is entitled maybe to business class or economy class, for example. So that has to be indicated for purposes of administration of this particular contract. Then you have leave entitlements. So this particular person could, for example, have 30 days annual leave, for example, per year. Then you have termination requirements in terms of notice, maybe 1 month notice, 2 weeks notice, pay in lieu of notice if the person has to leave, union representation. And in the union representation, this is where applicable. Some of the employees may not be unionizable. So these are just some of the basic aspects that should be captured in a contract of employment. There are also other aspects that are also critical. For example, an employee may be in terms of maternity leave, or paternity leave, that is also important. Then you also have what you call public holidays. That is also important to be indicated. Then you also have allowances that may be specific to this particular job and so on. Then you also have confidentiality clauses. For example, in some organizations, an employee may be informed that the employee will not be able to participate in the kind of business the employer is doing until, say, after 2 years. So that then becomes a confidentiality clause that the employee is supposed to participate in and so on. So, dear learner, these are just some. We can go through them again. We have indicated that employee contracts refer to the agreements that are entered into between an employer and an employee regarding a service of employment, and these employment contracts can be oral or can be in writing. Now, what are some of the basic aspects that should be covered in a contract of employment? So one, we have indicated names of employer and employee is important. Then the job title, for example, company secretary or human resource manager. Then the location of work where the employee will be performing their work, for example, Nakuru, Nairobi, and so on should be specified. Then duties and responsibilities should be specified. Specifics should be provided. Then terms and conditions of employment under which that employee is operating must also be provided. Then the date when the contract is signed, that is important. Then the commencement date of the contract. Then the law that may be used or may prevail in cases of disputes. And we have said in Kenya, the employment contract is governed mainly under the Employment Act 2007. Then the working hours of the employee, for example, 40 hours per week or 8 hours per day for 5 days from Monday to Friday, that should also be indicated. Then privileges and benefits, for example, air travel. Will the employee travel business class or economy class? Leave entitlements. The contract must be very clear that this particular employee is entitled to 30 days, maybe in a calendar year. Then there is the element of termination requirements, for example, notice, pay in lieu of notice, that should also be provided. Union representation, where applicable, should be indicated. Maternity leave, if the employee is entitled, for example, to 90 days maternity leave and maybe 14 days, maybe paternity leave, that should also be indicated. The public holidays should be indicated that in any given one calendar year, this particular employee is able to enjoy the public holidays, then allowances due, then confidentiality clauses. And what we are saying, dear learner, these ones are just some of the aspects. There are others, for example. How will sickness be handled? And this one brings us to what is called sick leave. Sick leave. It is important that it is indicated if an employee falls sick, maybe the first, say, 30 days, the employee will be on sick leave, maybe with full pay. That is important. Maybe the next 30 days, employee will be on sick leave, maybe with half pay. So that should come out very clearly in the contract of employment. So confidentiality clauses, sickness, terms of sick leave, and also aspects like grievance handling procedure, and other aspects like now intellectual property. Intellectual property. So when it comes to aspects like intellectual property, some workers may come up with some inventions. So if an employee comes up with an invention, how will that be handled? It's very important. The grievance handling procedure should also be documented very well. So Lana, these are some of the aspects that should be brought out very clearly, and failure to bring out these aspects in the employment contract sometimes has created a lot of challenges. So we have come to the end of our lesson today, and before we finish, I need to give you an assignment which you need to work on. Assignment. And your assignment is assess the basic information that should be contained in a contract of employment. So dear learner, this is your assignment for today's lesson. Assess the basic information that should be contained in a contract of employment. So until we meet for the next lesson, I want to thank you for being active in our lesson today, which was employee contracts, a lesson on employee contracts, which is a subtopic in our human resource management administration unit under the human resource management subject of the certified secretaries. So thank you very much.
At this moment, we can look at a question on how to tax a sole proprietor. So here is the question. I'll read and then I'm going to show you how the tax is usually determined. This is what the question says. Lois Rubandi is a sole trader operating as Lloyd Traders. She did not maintain proper accounting records but has provided the following information relating to her income and expenditure for the year ending that 1st December 2015. We have the summary of cash transaction for the year ending that 1st December 2015. We have the receipts, balance brought down, trade receivable, cash sales, commission received, capital. We go to the side of the payments, trade payables, cash purchase, salaries and wages, rates and insurance, medical bill for self, transport, bank charges, general expenses, loan interest, new motor vehicle, drawings. Summary of assets and liability as at January 2015 and that 1st December 2015. We have as at January 2015, as at that 1st December 2015. We have furniture, written down value, motor vehicle, written down value, trade payable, inventory, trade receivable, salaries and wages, due, prepaid rates, commission received in advance, capital. Additional information: number 1, discount allowed and discount received during the year amounted to 5,600 and 151,200 respectively. During the year, she took goods for free from the business worth 100,000 for her own use. Depreciation was ascertained as follows: motor vehicle 25% per annum on book value, furniture 12.5% per annum on book value, bad debts written off during the year amounted to 72,000. Required taxable income for Royce Rubandi for the year 2015 and the tax payable, if any, by Royce Rubandi. So we are supposed to, number 1, required, we get the taxable income of Royce Rubandi. So we said, whenever you are told to get the taxable income, first thing that you normally ask yourself, which approach am I supposed to use whenever you are taxing a business? Is it the gross profit? Is it the net profit method? From the question, we said net profit method is used when net accounting profit or loss or income is provided. From the question, there is nothing like that. And so if it is not there, so the first thing is to check if there is net accounting profit or loss or income provided. If it is not, then it is not provided, then automatically we use the gross profit method. Gross profit method, we said, we usually start with the sales. We less the cost of sales. We know, you can remember how we said you get cost of sales: opening stock plus purchases less closing stock minus any item that reduced the stock during the year. We get the cost of sales. Then sales minus cost of sales, we get gross profit. Then we add taxable operating income. We list them, and then we list the allowable expenses. We list them. Now, and then we compare. We take gross profit plus incomes minus allowable expenses. But we say that before you do any question on the gross profit, determine the first item that you are supposed to use, the sales. Have you been given the total sales? If not, then the first thing that you do, you have to determine the total sales. 2, have you been given the total purchases? If not, then you have to determine the total purchases so that you can prepare the statement. So in this case, we ask ourselves, have you been given the total sales? In the question, we are only given the cash sales. But just above the cashes in the summary of cash transaction, there is trade receivable, telling you that there was some evidence we sold on credit. So how much did we sell on credit? So that we add to the cash to get the total. We said if you are not given the credit sales, you have to open the debtors or receivable account to determine it. Then you add to the cash sales, then you get the total sales. 2, have you been given the total purchases? If you haven't been given, then you have to determine. In this case, have we been given? No. We are only given one part of this purchases, the cash purchase. So But were there some evidence there were some credit purchase? Yes. Just above the cash purchase, there is the trade payable. What does that mean? We had purchase on credit. So we have to determine the credit purchase. We add the cash purchase so that we can get the total purchase so that we can use it. So this is how you go about it to determine the total sales and total purchases. We say total sales is equals to the credit sales plus cash sales. The best way to do, you see the cash sales we have been given. What we need to find is the credit sales. Now leave a space here. When you're doing it on your own, leave like 1 or 2 lines here, where now you'll be posting the figures. When you get the credit sales where you post, the cash sales where you post, so that when you add the two, you'll get the total. Then, for you to be able to get the credit sales, we said you open the debtors or receivables account. So you'll come here after the 2 lines or so, debtors or receivable account. What you do once you open that account, balance at the beginning of the period, write it there. This is the debtors at the beginning. But don't look for it, no. You are just preparing a structure to help you to get the credit sales. Then you jump. The best way is to jump like 5 lines here, 5 or 4, and then the balance at the end, as we had said when we introduced to the taxation of the business, balance carried down for the debtors, you'll post them here, debtors. You'll post them, but don't look for them. It's just a structure. Then these lines represent where we'll post the totals. But now balance at the end we'll post here. And then we come to the purchases. We haven't been given the total purchases. How do we get it? So we say total purchases is equals to credit purchases plus cash purchases. Now, as we have seen, we have even been given the cash purchase. So what we need to find is the credit purchase. To get the credit purchase, we open the creditors or payables account. Same case, we jump like 2 or 1 line here. Then you open the creditors or payables account. Now, for the creditors, we start with balance at the beginning of the period here. Balance brought down. That is for the creditors. There. Then jump like 4 or 5 lines as we said with the other one, and then have the balance carry down for the creditors here. Then at the end, you'll get the total. You'll get the total. In this case, what we normally do, we go through the whole question. If we come across a cash sales, we'll post here. If we come across something that affects the debtors or receivable here, if it increase the debtors as we had said initially on this side, if it reduce the debtors on this side, then we come to the creditors. If we come across something that affects the cash purchase here, if it affect the creditors, increase the creditors being a liability, we post it on this side. Creditor, if there is any information that reduces the creditors, you put on this side, because as liability they reduce, you normally post them on this side. So let us go through the question and find out if there is any of such item. We start with the first paragraph. Don't ignore anything. We are told Lois Rubandi is a sole trader. She did not maintain proper accounting records, but has provided the following information relating to her income and expenditure for the year ending that 1st December 2015. There is no information that affects these items here, so ignore. Summary of the cash transaction for the year ending that 1st December 2015. We start with the debit. There is the receipt. On the side of the receipt, we have the balance brought down. Balance brought down at that point, it is the cash at the beginning. Cash at the beginning, we ignore. That doesn't affect. The next one is the trade receivable. So trade receivable, we have it here. And we can see it is on the receipt side, meaning we got money from the trade receivable. Trade receivables are data, debtors paid. When debtors pay, it reduces the debtors. So we post it on this side. So receipt. They have paid, and they paid 1226,200. 1226,200. After that, there is cash sales. Cash sales, just below the cash sales that we have here, 5620,000. Place it there. After that, commission received. That doesn't affect. The other one is capital. Capital doesn't affect. We go to the payment side. Trade payables. If you have trade payables on the payment side, that means that they paid their payables. So meaning payables reduced. When payables reduced, you post on the debit side. So we'll come here, payment. Payment, which we have 1005 200. Then we continue cash purchase. Cash purchase, just below the cash purchase where I told you to leave some space, 1620. 1620 800. Then after that, salaries and wages, that doesn't affect. Rates and insurance doesn't. Medical bill for self doesn't. Transport doesn't. Bank charges, no. General expenses, no. Loan interest, no. New motor vehicle, no. Drawings, no. That's the drawings of cash. Then we go to the summary of assets and liability as at January 2015 and December 2015. We have furniture's written on value, no. Motor vehicle, no. Trade payables, yes. Here we have the balance at the beginning for trade payable, 985,000. 985,000. And the other one at the end is 1180,000. So 1180,000. After that, we have the inventory, no. Trade receivables, yes. At the beginning, 781 here. 781,000. Then at the end, 821,400 here. Now that is the time that you're supposed to post when you come across the figures or the items. Then salaries and wages due, prepaid rate, no. Commission received in advance, no. That doesn't affect. Capital, no. Additional information, number 1, discount allowed and discount received during the year amounted to 5,600 and 151,200 respectively. Now, discount allowed reduces the debtors. When you give debtors discount allowed, it reduces what they are supposed to pay you. So you come here, discount allowed. So discount allowed, which we have 5,600. 5,600. And then we have discount received. Discount received, you receive from the creditors, people you owe money. So you'll have here discount received. Discount received, which we have 151,200. There. Then we continue. Number 2. During the year, she took goods for free from the business worth 100,000 for her own use. That does not affect any one of this. She just took goods from the business for her own use. Doesn't affect. Then number 3, depreciation was sustained as follows. Depreciation does not affect any one of this one. We go to number 4. Bad debt written off during the year amounted to 72,000. Bad debt does. So bad debt is usually from the debtors. That some people who have refused to pay and you have written them off. When you write them off, it means that it reduces what you are demanding from them. So you have it here. Bad debts written off. Bad debts written off, which you have 72,000. 72,000. Now you note that is the end of the question. Now what you do is to do the summation. Now we start with the debtors or receivable account. We want to know how much was the credit sales, which is supposed to be the balancing figure. The balancing figure. How do you do that? Take the totals on this side and write them here. We have 12,26,200, and then we add 5,600, and then we add 72,000, and then we add 21,400, which we get 21,7,200. Then this one should be the same as on this side, 21,7,200. Then the difference between this figure and what we have posted on this side, if we had like three, this one and the other two, the difference is the one that we post here as the balancing figure, but we only have one, so we minus 781,000, which gives us 1389,200. Now that we have the credit sales, we transfer here, so 1389,200, and then we now add the cash sales to get the total sales. So we add the cash sales, which is 5620,000, and then 5620,000, which give us 7,009,200. There. Now we come to the creditors. We want to get the credit purchase, which is supposed to be the balancing figure. We take the totals on this side, which is 1,005,200, and then we add 151,200, and then we add 1180,000, and then total, which is 23,36,400. Then we'll have the same here, 23,36,400. Then we minus the totals on this side. On this we only have one for now. If we had two figures, the three, we could have minus them. So 985,000, which gives us 13,51,400. There. We have the credit purchase. Now we can transfer the credit purchase here, 13,51,400, add the cash purchase. So we add cash purchase of 1620,800. 1620,800, which give us 29,72,200. There. Now we have our total purchases and our total sales. From there we can prepare the statement. So we come here, the name of the business, it is the Lloyd Traders. So we come here, Lloyd Traders, sole proprietor, taxable income, for the year ended, for the year ended 31st December 2015. So we'll have a column where we'll be posting the figures. And as we had said about the gross profit method, we start with sales, of which case now sales is the one that we have determined here, 7,009,200, and then we less cost of sales. For the cost of sales, we start with opening stock. Opening stock is in the summary of the assets and liabilities. Inventory at the beginning, 1241,600 plus the purchases. The purchases is the one that we determined here, the 2972. 200. We minus the closing stock. Closing stock, which we have 14,600. And then remember to minus any item that reduced the stock during the year. And we say items that reduce the stock during the year are like damaged, stolen, withdrawn stock. For this question, we only had one price. Number 2, during the year she took goods for free for the business worth 100 for her own use. And they are goods. They must be goods, not cash or when silent. When silent, just ignore, because in that case you cannot assume they are goods. Only when they are goods or inventory that they do or we do come and deduct them here. So she withdrew 100,000. Now, having no other, we close the bracket and get the total. The total, that is the net, 1241 is 600, and then we add 2972, 2972 200, 2972 2972 200, and then we minus 1480 600, and then we minus 100, which we get 26 33 200. And that will give us the gross profit. So gross profit, which would be, we take 7,000 9,200, and then we minus that figure, which give us 43,76,000. After that, we usually add other taxable operating incomes. Now, the best way to do it, instead now for you to go and look for the taxable operating income which you list here. Remember, we had looked at the topic on the on an area on taxation of operating income or taxable operating income. Now, instead of looking for them, it will be a waste of time. The best way is leave a space of like 3 or 4 lines here, and then now less. Remember, in the statement when you're using the gross profit, we said once you add the taxable operating income, you less allowable expenses. Allowable expenses. So you have left 3 or 4 lines, and then now you have less allowable expense. I want to underline, because these are headings of the figures that will be posting, or the items that will be posting, of the taxable operating income here and allowable expenses here. We need to go through the question, look for a taxable operating income which will be posting here, allowable expense here. We start from the summary of cash transaction, because up there in the first paragraph there's nothing. The first, under receipts, balance brought down, we say that's the cash at the beginning of the period. We ignore. It is not an income. It's just a cash we had when we were starting the period. Trade receivable, that we used it to get our debtors here, our sales here. The other one is cash sales. It was used to get the sales. Commission received. Commission is an operating income, not an investment, and it is a taxable operating income. Now, having gotten the commission, what you do is this. Check around if there is any other place that commission has been mentioned. If you go to the summary of assets and liability, there is another commission received in advance. So what do? When you have it, somewhere else it has been mentioned, have commission income here. Then open a bracket of the information given. If something increases the item like commission add, it reduces the commission less. Like now, and also, if the commission is relating to this year, you add. If it is relating to another year, you minus. That's simple logic. Anything for this year, you add. Anything for another year, you minus. Like if we start with the commission received, you see it is that in the transaction for this year, commission received in the year, it is for this year. So we add. We add 124,000. Then, in the summary of assets and liability, commission received in advance, and we have at the beginning and at the end. Now, if you receive commission in advance when you are starting the year, ask yourself, you are receiving it in advance for which year? Don't look at when it was received. Look at it is relating to which year. When you receive it in advance at the beginning, it is for this year. The year we are taxing, like in this case, it is the year 2015. Received in advance in January, it is for the current year. Yes, it was received last year, yeah, because it was received in advance by the beginning. It must have been received last year, but it is for the current year. Anything for this year, we add. That's what we have said. So we have 80,000. Then, commission received in advance at the end of the year. When you receive commission at the end in December, it must have been for the following year. So not this year, for the other year. So in that case, we minus 136. So we need to compute the net. So we say plus 124,000 and then plus 80 and then minus 136, which give us 68,000. 68,000. Then we go back to where we found that commission. We found it in the summary of cash transaction for the year. Then continue from there. Don't jump anything. Consider everything provided. After commission, there is capital. Capital, yes, it is not even an income, because capital, it is what the owner introduced into the business to assist him to run the business, So that's not an income, and it's not even an expense. We go to the payment side. Trade payables, we used that to get the purchases. Cash purchased, we used it here. Salaries and wages, that is an expense. And salaries and wages, we said is a allowable expense. Unless it relates to the owner, it is allowable. So we'll have here salaries and wages. But as we said, before you post it, check if it is mentioned somewhere else. It is mentioned in the summary of assets and liability. Almost in the middle, there is salaries and wages due. Higher. We have to adjust it the way we said. We start with the one that was paid in this year. If it was paid in this year, it must be for this year. We add 1660, 400. Then we go to the summary of assets and liability. Salaries and wages due at the beginning. Due at the beginning, it must have been for last year, because it is what the arrears that were supposed to be paid last year, but they were not paid. So which year are they relating to? It is last year. Yes, they will be paid this year. Actually, they are in this 1660, 400, because it's arrears for last year, they must have been paid here, but they are not relating to this year. The workers offered the service last year, only that they were not paid. So since it is not for this year, minus, and we minus the 184,000. And then we have salaries and wages due at the end of the current year. At the end of the current year, that is for this year now, because it is workers offered the service this year, only that we didn't have money to pay them by the end of the year, but they rendered the service this year. So the income was generated, the one they assisted to generate was for this year. That one we add. We add 150,000. Now, because there's nowhere else we have salary being mentioned, we can get the net. So 1660, 400, and then we minus 184,000, and then now we add 150,000. So in this case we get 1626, 400, which we minus. And it's also important for me to mention that this one we normally do it this way, instead of opening the salaries and wages account or even the commission account where you try to get for commission for this year, the one that you bring here, or this, it will give you the same, but that's a long process. It's a wastage of time. Just do it this way. Then we go back to where we found the salary. After the salaries and wages, there is rates and insurance in the cash transaction. Rates and insurance, that's allowable because they are for the business. They are allowable expenses. So we'll come here, rates and and insurance. Now, we check if it is mentioned somewhere else, that rates and insurance. Yes. If you go to the summary of assets and liability, there is prepaid rates, that last item. So we have to open a bracket there. And we start with the rates and insurance in that year. The one that was paid, it is for that year. We add. And we add 320,800. 320,800. Now, when you come to the prepaid at the beginning, you see when you are starting the year, January, and you have a prepayment, that must have been for the current year. You are prepaying for the current year. That we add. We add 50,000. And when now you get to the end of the year and you have a prepayment, you are prepaying for the following year, which means whatever you paid this year, part of it was for next year, that one you minus. So we minus 72,000. Having no other place it has been mentioned, we get the net, which will be 320,800, and then we add 50,000, and then we minus 72,000, which give us 298,800. There. We go back to where we found that rate and insurance in the cash summary. After rates and insurance, medical bill. Medical bill is allowable, but the problem this time is for self. And we said here, when you are taxing a sole proprietor, any expense relating to the owner, private expense, we don't allow. This we even said when you are looking at the general allowable and non-allowable expense. And an unallowable, anything to the owner, we don't allow. Private expenses. So that is not allowable. We won't deduct. The other one is transport. Transport is allowable and it isn't mentioned anywhere else. So transport. Transport, which you have 56,400. After transport, bank charges. Bank charges are also allowable. They are for business and they are not mentioned anywhere else. Bank charges. Which we have 3,000. 3,000. After that, general expenses. General expenses are also allowable. There are small expenses that are put together for the business. General expenses. General expenses, which you have 145,400. The next one is loan interest. Loan interest, we said interest on money borrowed and invested in business is allowable. So loan interest, allowable. Amount, 120,000. After that, new motor vehicle. Fixed asset, we said we don't allow. We allow capital allowance. Of which case we said motor vehicle, capital allowance at the rate of 25%. Capital allowance, written in short as CA, motor vehicle, 25%. But check whether you have the balance at the beginning. We take the balance at the beginning. If you go to the summary of assets and liability, at the beginning we had a motor vehicle, 960, of which case will be 960. Then add the one that was purchased in that year, which was 600,000. With nothing more, get the amount. That will be 960,000 plus 600,000, giving us 1560,000 times 25%, which give us 390,000. We go back and continue. After the new motor vehicle, drawings. Drawings, we said they are private expense. They are for private use. We don't allow them. Then we go to the summary of assets and liability. Furniture. Furniture is a fixed asset. We claim capital allowance on it. So we'll have capital allowance on furniture and fitting, in short. So 10% off. We start the balance at the beginning, 120. And there was no addition of furniture. There is nowhere we are told about addition. So we just take 10% of 120, which gives us 12,000. After that, we go back. Summary of assets and liability for furniture. We have considered motor vehicle. We had considered already. It's there. Capital allowance. Trade payables, that's not an income, not an expense. Inventory, not an income, not an expense. Trade receivable, not an income, not an expense. Salaries and wages, we had considered. Prepaid rates, we had considered. Commission received in advance, we had considered because we had met them earlier. Capital, no, that's not an income or an expense. Additional information, number 1, discount allowed and discount received during the year were 50,600 and 151,200. Discount allowed is an expense and an allowable one. We'll have discount allowed. Which we have 5,600. Then discount received 151,200. That is an income and a taxable one. We had said that when we were looking at the general taxable and non-taxable income. Discount received, a taxable operating income, 151,200. Then additional information number 2. During the year, she took goods for free from the business worth 100,000 for her own use. That's an expense, yes, but it's not usually allowable, we said, because it's for private use. Number 3, depreciation was ascertained as follows. Remember, we said depreciation is not allowable. What we allow are the capital allowance in taxation, which we have considered. So ignore. Depreciation is not allowed. Number 4, bad debts written off during the year amounted to 72,000. Trade bad debt written off are allowable. Unless we are told they are not relating to the trade, to the business, they are allowable. Bad debt. And take note, don't confuse with provision. Provision are the one that we say specific provision we allow, general provision we don't. Bad debt are bad debt, and they are allowable as long as they are relating to the business. Bad debt written off, which we have 72,000. Bad debt is the last item provided. So what do you do now? We are done. We now have to get, we come now to the end here. We get net taxable operating income. So from operation, how much is the total taxable income? That means that we take the gross profit plus this income minus the expenses, allowable expenses. We start with 43,76,000. Then we add 68,000. And then we add 151,200. And then we minus 1626,400. And then we minus 298,800. And then we minus 56,400. We minus